City on this Wednesday, October 30th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Yeah, first up, big tech earnings. They are underway, folks, with Alphabet shares jumping as AI bets pay off here. The company is seeing growth in its search and cloud computing businesses. Meanwhile, shares fell after its outlook for the current quarter came in below Wall Street expectations. However, pre-market, you're holding on to some gains there. Investors now looking ahead to the next batch of tech earnings after the bell, with Microsoft and Meta reporting results.
Plus, Eli Lilly shares tumbling this morning, the drug maker lowering its full-year guidance after sales of its blockbuster weight loss drug fell short of estimates. The company had previously raised its full-year guidance twice this year, but is now trimming $600 million off the top end of expectations. Lilly cited inventory issues at wholesalers for its sales miss.
And the first estimate of third quarter GDP data out this morning showing the U.S. economy expanded at a robust 2.8% pace in the third quarter. Consumer spending, which accounts for the largest share of economic activity, that advanced 3.7%, the most since early 2023. And ADP private payrolls offering the latest view into the labor market ahead of the October jobs reports this Friday. The numbers surging past estimates, showing 233,000 jobs added in October. The estimate was for 111,000. Let's kick it off with Alphabet and AMD. A mixed picture from the big tech names reporting after the bell last night here. And there you're taking a look at shares right now, and that's where that mixed picture comes into play in addition to what the companies had to say. Alphabet shares moving higher by about 6% here pre-market, and AMD, you're seeing those sliding by about 7%. And this all comes back to how they're prioritizing some of their own AI initiatives here. For Alphabet in itself and some of the different features it's going to roll out, sounds like creators might have something to get excited about. Sounds like the cloud services side of the business, which certainly was in focus here, has some things to be excited about as well. So more largely the monetization and investors waiting for that, and now starting to see that monetization take hold at some of these companies, going to be key for this earnings season. Yeah,
it certainly is going to be key for this earnings season. And I also think this puts to rest some of the worries about the aggressive spending that we see not only from Alphabet, but from many of its big tech peers on AI, as investors have been concerned about that return on investment, what ultimately that is going to look like. When you take a look at the move here in pre-market trading, you're up just about 6%. That's significant given the size of this stock right now, and also just given the outperformance that we had seen here over the last couple of years. A couple of interesting comments from Sundar Pichai on the call. One of those just being the engagement and the strong engagement, is how he characterized it in the AI offerings, and just what ultimately that could spell out just in terms of future opportunity for growth here down the line. That's something that stuck out to me. And he was also just talking about the fact that people are asking more complex questions, and that just shows just how much better this technology is getting, how much more improvement we are seeing on a daily basis. And then also I really think that improves just the trajectory, what that growth opportunity looks like, not only for a leader like Alphabet, and I think they very much prove that they are very much a leader within the AI space in these results, but also just what it means for so many of these smaller companies that have started to invest in AI, what maybe potentially that could unlock then down the road.
Yeah, absolutely. And then just briefly here, we mentioned AMD. Just want to quickly give a nod to that as well here, as we were seeing shares sliding pre-market here right now. I mean, this is a company that also has high, apple pie in the sky type hopes for investors out there. And not meeting on some of that is certainly going to allow for a stock reaction like what we're seeing here. But ultimately, take a look at some of the areas that did show some growth, significant growth. Data center segment revenue, that increased 122%. That was still a record, folks, $3.5 billion there. And they also believe that they gained server CPU share in the quarter as enterprise wins accelerated there. So still a lot of check marks that the street is looking for from here, and that being priced back into some of the expectations.
Yeah, again, third quarter results were strong. A lot of the questions coming in the guidance figures there for AMD. All right, well, one down, 4 to go. Alphabet was the first of 5 Mag 7 names to report results this week. Joining us now to discuss, we want to bring in Paul Meeks. He's Chief Investment Officer at Harvest Portfolio Management and Wall Street Beats partner. Paul, it's great to have you back on the program with us. Let's start with what we heard from Alphabet. We're seeing a pretty significant move here in the pre-market. The stock up nearly 6%. That's a big deal, just given the size and scope of this name. What did you think of the results?
Overall, I was favorable on the results. Like anything in life, there's a mix of good and bad. I was disappointed in year-to-year revenue growth in digital ad sales of only 10%. However, Google Cloud absolutely knocked it out of the park, growing 35% year-to-year. I think when we see the results for Microsoft Azure and Amazon Web Services, and even Oracle Cloud Infrastructure, that you'll see that Google Cloud really gained some share in cloud infrastructure market. So I think that's very good. In the meantime, you have a stock that even after today's move is trading at a PE multiple on next year's earnings, that not that much higher than the S&P 500. And so I was not bold enough to buy it heading into the quarter. But you know what? Even after today's move, of course, I've had the position for years. I'm a tech investor. I might even add a little bit.
It's interesting. You also have a new CFO making an earnings call debut. Alphabet's new CFO, Ashkenazi, of course, on the call, not Ashkenazi. And last night, the executive saying that one of her top priorities is cutting costs as Alphabet continues to spend big on AI. I want to play this clip for you and for our viewers and then get your reaction on the other side, Paul.
Sure.
There's really good work that was done, started by Ruth Sundar and the rest of the lead team to re-engineer the cost base. But I think any organization can always push a little further. I think not just about the size of the organization, but mostly how we operate and how we run the business. And I think when you simplify the organization, Sundar just made a few comments on that. And when we use AI within our own processes and how we get work done, there are some efficiencies or opportunities for efficiencies.
So with that in mind, where do you think those additional opportunities for cost cutting are going to come in, and how soon might we expect to see those, Paul?
So I actually think that it's going to be rather easy to show efficiencies within the company's own cost structure. I've always been a little bit more cautious, not just with Alphabet, but with other companies playing the AI trend as to when they're going to have outward-facing products that can be adequately monetized. I think the jury is still out on that, and I don't think we'll even get the complete answer to that even in 2025. But sure, that's music to my ears. You want to have a CFO spending on the right things, but not spending frugally. So that comment that she made was right out of central casting. And yeah, I'd like to see more and more improvement. The nice thing also about Alphabet is it had a very nice pop year over year in operating margin, about 300 or 400 basis points. So maybe they're already delivering the mail there with some cost efficiencies.
Paul, real quick, I want to get your thoughts on AMD. We're seeing the stock sell off just a bit this morning. Lots of questions or concern maybe about the guidance that was given. We're also seeing, though, some weakness reflected in NVIDIA stock today as a result. You're looking at NVIDIA also off just about 1%. Should investors be viewing this as a buying opportunity for NVIDIA?
I have a third of my portfolio in NVIDIA. It's been a rock star. I don't think what AMD said yesterday is going to put NVIDIA in peril. And with the big move that NVIDIA has already seen, it's its shares, the fact that it's only down 1% today on AMD's sins, I actually think is a pretty good sign. The way I look at it is, AMD is a fine company, right? They turned it around. Dr. Lisa Su, one of the best executives in Silicon Valley. The problem is it is not an AI accelerator chip pure play. It's got a CPU business too, and that business right now kind of sucks. And so the way I look at it, even though AMD will be a viable number 2 to NVIDIA in the AI chip market, and even though the stock trades at a discount to NVIDIA, I just go with the pure play. I just buy more NVIDIA on this news and continue to avoid AMD, which has been a good trade for me.
And so, Paul, with that in mind, it being the largest position in your portfolio, I imagine you've been doing some dollar cost averaging over time into that position and growing it out. Should investors who are trying to figure out if they should be buying NVIDIA ahead of earnings, ahead of an election, And even amidst any type of geopolitical broader uncertainty, should they feel comfortable still adding into an NVIDIA position?
Yeah, it's a great question that you ask. I haven't added to it for a while. Of course, my cost basis is several years ago. I think with all the stuff that's going on and the run that the stock has had, if you own NVIDIA, I just hold it. Unfortunately, we're not going to get a earnings report from them for too long, about a month or so. So let's just hold in. Like all these stocks, even NVIDIA, they always have a bad day. Usually it's based on something that they can't control, something macro. You will get a chance to buy NVIDIA lower, but for now, just cool it and we'll see what happens on the quarter. But I don't expect the stock to act after reports like AMD has acted today.
All right, Paul Meeks, who is the Chief Investment Officer over at Harvest Portfolio Management and Wall Street Beats partner. Paul, always a pleasure to get some of your insights. Thanks so much.
See you, Brad.
See ya. Third quarter GDP data this morning showing the U.S. economy expanded at a robust pace in the third quarter. And while ADP private payrolls surged past estimates to show 233,000 jobs added in October. Joining us now for even more on this, we've got Veronica Clark, a U.S. economist for Citi. Veronica, always a pleasure to get some of your insights as well here. So just take us into the more outsized proponent of some of the economic data that we're getting over the course of this week and especially here today. Which kind of plays larger in the kind of spelling out of the economic picture right now?
Yeah, we will get a lot of data this week. That really started yesterday. I think, of course, the most important is going to be that October employment report on Friday. So that's the official government data. Obviously, we got the stronger ADP reading this morning, but that really has not been a great indicator of what we should expect to see in those monthly reports from the BLS. We're still expecting only 90K jobs added in October in that data on Friday. There will be issues of strikes and hurricanes in that data. This GDP report today, of course, very positive, but a bit backward looking at this point. Most of this Q3 data we already knew.
Veronica, though, when we are focusing on that GDP data, the one thing that stuck out to me within this report was that core PCE inflation coming in just as a bit of an upside surprise. What does that signal to you in terms of tomorrow and maybe just in terms of the Fed's or what that tells us about where the Fed is in its fight to tame inflation?
Yeah, it doesn't really impact the reading tomorrow too much. Of course, tomorrow we'll get the monthly data for September that is baked into this Q3 number. Should see something like we're penciling in 21 basis point increase in the monthly core reading for core PCE, but maybe you see a bit of an upside surprise, something like a 0.3 rounded wouldn't be too surprising. Most of the elements of September inflation we do already know from the CPI and PPI data, and it did pick up in September, but we have been running something pretty close to 2% on a 3-month kind of average basis. I think that is still okay for the Fed.
But Veronica, is it inflation flight? Is that as under control as maybe the market is pricing in or the market anticipates right now?
I do think there are a lot of reasons that inflation should continue to slow. One really important one is shelter inflation. That's a really big component of both CPI and PCE, and it's been very strong for a while. But we have seen new rents slowing. It might be a bit choppy, but that does look like it should be coming down. Obviously, as the Fed is cutting, we would maybe be worried about some reflation risk, but where you would expect to see that first is a sector like housing. We really don't see much upward pressure on home prices. We really haven't even seen housing demand picking up. And of course, now mortgage rates are actually even higher than they have been in the last couple months. So I think that reflation risk is still pretty low.
What do you think in terms of the sentiment that people and potential participants in the labor force are really kind of working through right now as thinking of a job is hard to get, and how that's playing into the broader consumer sentiment as well right now?
Yeah, that was a really important reading that we got yesterday in the monthly consumer confidence data from the Conference Board. An important detail in that data is this labor market differential. So the difference between how many people are saying jobs are plentiful, less saying jobs are hard to get. And it did improve a bit in October, but there has been a pretty consistent trend of people feeling worse about the labor market. And it does then line up with something like very low quit rates that we saw in the JOLTS report yesterday. People are not going to be quitting jobs if they don't feel good about finding a new one. So there does seem to be something happening in terms of how people are feeling about the labor market. That jobs hard to get response rate does really well correlate with the unemployment rate, which we have seen that rising. So I do think there's this underlying weakening happening.
All right, Veronica Clark, always great to talk to you. Thanks so much for taking the time
Thanks.
to join us here this morning. Coming up on Morning Brief, we break down Eli Lilly's results after the company reported a surprising miss in sales for its weight loss drug. Plus, we sit down with the CFO of Chipotle as sales fall short of investor expectations. And we count you down to the opening bell on Wall Street. Futures shifting into positive territory amid resiliency in the U.S. consumer. We've got all that and more coming up on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's go to the interwebs. Reddit, soaring on better than expected third quarter results as investments in advertising technology pay off for the company. The social media company also issuing a strong forecast for the holiday quarter. The site averaged more than 97 million daily active users in September. It's up 47% year over year. The stock has more than doubled since the company went public in March, up by about 25% here pre-market. And this is also one of those social media AI plays, as well as the data that's on the platform. They're looking to be able to make sure that that's part of being able to leverage that as data sets that's ingested within generative AI as well.
Yeah, and I think the executives have real focus here on improving the search platform.
Yeah.
That has certainly proven to pay off. There was a note out from Piper Sandler this morning talking about the fact that Reddit is now the 6th most searched word on Google in the U.S. so far this year. So we have seen improvement there, and I think some of that is just reflected in the results and some of the numbers that you were just ticking through. I think one of of the concerns maybe or worries is just in terms of how much the stock has run up, right? We have the 3-month on the screen right now. It's up 36%. The 6-month, we're closer to that 60% payoff level. So I think questions about that momentum and what ultimately that looks like here. 6 months, you're actually looking at gains of 76%. So here we are trading above 81. When we're talking about valuation, some concerns there. I think that could be creeping into the stock here. But again, when you take a look at these numbers, very, very strong results here from Reddit and really proving the fact, and with that 25% jump here in pre-market trading above $102 a share, really proving the fact that they have grown significantly, that their presence is very much felt, and that they are a real competitor within this space.
Yeah, the profitability is key here, and being able to show the street that you can sustain that as well here. Net income, $29.9 million. You compare that to a net loss of $7.4 million in the prior year here. Gross margins also coming in at 90%. Yahoo Finance's Brian Salzi is going to be sitting down with Reddit CEO Steve Huffman today. You can watch that at 3 p.m. Eastern Time right here on Yahoo Finance.
Let's take a look at another big mover here this morning. We're taking a look at Snap, beating third quarter estimates for revenue and user growth, boosted by new ad technology and a new app layout. The company also announcing a $500 million stock buyback. Daily active users growing 9% from a year ago to 443 million. Still, Snap issuing light fourth quarter guidance. Maybe that's why we are well off the highs of the pre-market session here. We're now looking at gains of just about 5%. But again, when I took a look at the quick reaction that we are getting from the street, the improvement in execution, the progress on the platform initiatives was something that a number of analysts called out here this morning. And also the Barclays note, they were talking about the looming divest ban here that's hanging in the balance for TikTok and what ultimately that would mean for Snap down the line. And that's something that investors and analysts are still trying to factor into their estimates and what ultimately that would do, then how big of a boost it could be if we were to see a ban, how big of a boost that could prove to some of these other social media platforms.
Yeah, it's a great point. They're also going through a period of trying to redesign and reconfigure the experience.
They've been going through that period for a while.
I mean, Simple Snap, that's the latest effort, though.
It is.
In the,
there's
of
always
course,
the latest effort.
I mean, in the chronological order of all the changes that have taken place on the Snap platform, there's going to be some new ones as well. And Stories and Snap Map not going away entirely for those folks that are concerned about Simple Snapchat and what it could mean here. But for investors, I think, even despite shares moving higher here pre-market by about 5%, as you mentioned, off of some of the more outsized move that we had seen here off the back of earnings, investors starting to really try to figure out how they need to understand what the monetization dynamics are going to look like. And Evan Spiegel is concerned about this, or at least communicating to investors that that's something that they're taking time to understand as well. He talked about that on the call with regard to Simple Snap here and rolling out this simplified version of the app. And so we'll see exactly what that does look like in the monetization, but then also some of the new monetization efforts as well for advertisements, sponsored snaps, promoted places. They talked about a lot of the businesses that are focused on driving people in store into their retail locations to strengthen a customer relationship, and brands feeling like they may be what they call disintermediated with their digital relationship with customers. So we'll see if those specific advertising opportunities as well within the platform pay off. And of course, they're going to be going head to head with some of the new spectacles products that are out there in the market too. Facebook versus Snap, Meta versus Snap.
Yeah.
I don't know which one.
I have a hard time thinking that they're ever going to catch on, except our executive producer, John Hyland, loves them.
Really?
Not Snap, I believe.
He likes the Meta. John, get in our ear.
Meta?
He likes the Meta ones.
Meta
He just told us in our ear.
But still, it shows that there's some appetite for those wearables out there. And I think that's been the big question, is who would be buying these?
I mean, when you slap Ray-Ban on it, it seems that much sexier, I guess. You're like, all right, I got the
Maybe that was
Ray-Ban
a selling
specs.
point for John.
Maybe it was. John, you can confirm or deny that later on or in our ears right now. For right now, though, we got to turn to Eli Lilly. He says no comment. Okay. Finally, Eli Lilly tumbling after missing third quarter estimates as revenue for its weight loss drug Zepbound fell short. The company also slashing its profit guidance. Yahoo Finance's Anjali Kemlani joins us now with a closer look at these results here. Hey, Anj.
Hey, yeah, definitely a shocking surprise from Eli Lilly there. We know that the street was expecting much better numbers coming out of the quarter for Zepbound and Mounjaro, especially considering that the FDA took these drugs off of shortage. So Eli Lilly did confirm that they do have supply. That's not an area of concern. And these numbers are really something that may tell a story that could be coming up. We did see Novo Nordisk miss last quarter. We'll wait to see what their numbers are. So is the competition maybe drying up? Is there some softness in the market? Those are questions that we still have not had answered, and it's going to be something that we observe. We have seen bariatric surgery, for example, decrease in the year. So what is the GLP-1 story is surprisingly something we're still trying to figure out. So let's take a look at the numbers for Lilly and what caused this drop. As you mentioned, the updated guidance on the higher end reduced to $46 billion for 2024. Meanwhile, we got an update on the range as well for EPS up to 13.52 per share. So that's just what to look for the end of the year. I had a chance to chat with Dave Ricks, CEO of Eli Lilly, earlier, and talked about how he's thinking about the story for GLP-1s. He mentioned when it comes to production, of course, we know the FDA is reconsidering the shortage designation, but he says underlying production is on track to beat our goal of 50% increase year over year growth. So that is something to keep an eye on. The company is actively pushing out more product. We also know through Lilly Direct, which is the vials available for patients, as well as those auto-injector pens. In addition, talking about this idea that maybe there's softness, he said, quote, growth for us is sequentially growing 25% quarter over quarter in the US on a demand basis. We've also seen Zepbound, which is the weight loss drug, increase significantly over Mounjaro, the diabetes drug, and start to take away a little bit more market share from competitor Novo. So you see the numbers down still just based on that miss, and it's going to be interesting to see what he kind of signals to Wall Street, what he is telling investors on the call later this morning. But it's an interesting story.
It is a very interesting story, and you can tell, I think, just by the stock's reaction and even just a quick analyst take this morning, just how much of a surprise this really came from or came about to be here for analysts. I'm curious just in terms of how much you think this changes the narrative around GLP-1s going forward, or at least maybe over the next quarter or two.
So
or does it?
I think it's right now we're in a period of the hype maybe is gone. And so now we're in what does the normal market look like, right? And when Novo gets off shortage too, what does that full story look like? Those are the things that I'm waiting to hear and see. And I think it's interesting that some analysts are predicting that it might be a little bit softer. What the new approvals will look like, especially when they enter sleep apnea and fatty liver, and we saw, Novo get into cardiovascular. So all of that is part of the story, part of what other approvals they can get, how they can get more revenue in. Ex-US is also part of that story. They had to push out some of those dates to make sure they fix the US market first. And so now they're entering all these new markets. So will that balance out the revenue in the coming quarters? So even if there is a little bit of a dip, it is covered by the new markets. Well, that's a lot of nuance, but I'm waiting to see all of that.
A lot of nuance, yeah, exactly. You're looking at Eli Lilly shares again off just about 11% pre-market. Anj, thanks. Keep right here. We've got the opening bell coming up next.
There you're taking a live look at the opening bell at the Nasdaq, where you've got GQQQ ringing the opening bell. Actually, Astoria U.S. Quality Growth Kings ETF. That's what that is. And then, oh yeah, you've got Water for Elephants ringing the opening bell at the NYSE. You may know him from the book. You may know him from the movie with Reese Witherspoon. A few folks in our control room and in our studio do. And now you might know them on Broadway. Let's take a look at how the markets open up here on this Wednesday. Taking a look at the Dow Jones Industrial Average, we are down right now by about 0.2% here, slightly slagging just a little bit. But as you're taking a look at the S&P 500, they're flat, just barely to the downside. The Nasdaq Composite, as things are calibrating here this morning, just after the opening cross, we're seeing that flat, just barely to the upside. We have seen some oscillation here in the futures now, of course, transpiring into the start of today's trading activity. And let's take a look at some heat maps here as we begin today's trading session. And we'll just take a look at the 11 S&P 500 sectors. I know our own Jared Blickley has much more of a deep dive in a hot second here, but take a look at these 11 sectors. Right now, you've got communication services leading the charge right now. It's up by about 1.5% here. And then additionally, on the other side of that, pulling up the caboose, yeah, you've got XLV. That would be your healthcare sector right now for the S&P 500, down by about 1.4%. We are more in positive territory than negative territory in terms of those 11 sectors here. But as of right now, that is the way things are shaping up to begin today's trading activity. For much more, let's get to Yahoo Finance's Jared Blickley for a look at what's moving. Hey, Jared.
Hey, Brad. Well, let's take a look at the Nasdaq here. I think that breakout yesterday, 2 record highs, that was the first since July. I think that was a significant event. We've been watching it just squeeze higher, and we finally got the breakout. And I've been noting a lot of markets that just wanted to break out here, and so I'll give a few in a second. That was one of the big ones. First, I want to concentrate on the bond market, which is heading down for 2 straight days in a row. You see those 2 red candles there. I'm going to zoom out to a 3-year so you can see the negative trend line that we just bumped up against. So on a technical basis, we did not want that to go beyond that line, and it is indeed retreated off of that line. So that's good news for equity bulls and basically good news for the risk markets here for the time being. And just going back to the sector action, XLC, that is an alphabet story. So let's take a look at the NASDAQ because Google technicals have been looking really, really interesting. I'm going to zoom out to a 3-year chart. Let's do a 5-year actually. And you can see how we had this giant cup here. We broke to the upside, came down, tested the prior resistance level. That became support. And now we're heading to the upside. And let's take a look at the 3-month chart so we can see this inverted head and shoulders that we just broke out of. And guess what? We are back up to the highs, close to the highs of the year. And my concern is that with a huge move like this, you probably need another catalyst to get beyond those highs. And with earnings just out, you got to wonder what that would be. Maybe it's another earnings, but nevertheless, the hard work being done by the bulls there. And then just wanted to note real quickly that Eli Lilly having a really rough go of it. This is ending up to be its worst day since before the pandemic. I have to go back to my charts here, but 11.47%, just a really big give back in terms of some of those prior gains. But you'll notice it just came back to prior resistance levels. So we'll see if that holds as support. Got to go to gold real quickly and we'll see if I can pull that up. GC is at another record high. We saw that at about $2,800 an ounce, and that's nickel. It didn't hit the whack-a-mole just there. Here's gold futures up 35% now year to date. Didn't even get to Bitcoin, but guess what, guys? Bitcoin flirting with record highs as well.
All right, Jared, thanks so much for breaking that down. Another day, and Bitcoin once again with those record high levels. Talk a little bit more about that coming up in the next hour. But first, let's get to some of the market action that we're seeing this morning. The S&P 500 currently trading just above 5,800 as it hovers near all-time highs. Our next guest seeing that benchmark surpassing 6,000 by the end of the year. But are there some risks that could threaten to disrupt the climb higher? Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. Sam, it's great to see you. So talk to us just about where things stand today. Lots of questions about whether or not there is enough left here in this market to continue the push higher. Certainly a lot of uncertainty when it comes to the election, when it comes to future Fed decisions, also just valuation concerns right now. What's your read?
Well, good morning, Shauna. My read is that when you look to what typically happens in the final 2 months of an election year, the S&P gains about 3%. And if you add 3% to where we are right now, That puts us slightly above that 6,000 threshold, which I think, in a sense, sort of acts as like a tractor beam pulling the market up toward it. I think the enthusiasm would really come from just the election being over, and therefore the uncertainty being resolved. And if we continue to see improvements in earnings, question then is, what about the Fed and what about their decision in early November? And our expectation is that they will be cutting rates again. And then we just started what's called the best 6 months of the year by the Stock Traders Almanac. And historically, a strong May through October offers a running start to the next November through April period.
Okay, and so how much weight then does the Fed have in all of this if much of it is focused around what's typically taking place post-elections? I mean, we're still amid the Fed just kicking off its rate cutting cycle.
Hey, Brad. Well, essentially, I've been saying that when it comes to rate cuts, wanting is more profitable than having. That in the 6 or 7 times since 1990, when the Fed actually told us that they were making Fed funds rate changes, the S&P gained 18% leading up to that first cut. However, after the first cut, the gain was less than 3%, primarily because, in a sense, we already got what we expected to get. And now the question is, will the Fed be slower to lower interest rates if employment comes in stronger with the non-farm payrolls report on Friday, as it did today with the private read? And if we end up seeing an economy that continues to be fairly strong with a very resilient employment picture, et cetera, the Fed might decide to sit on its hands at either one of these upcoming meetings, November or December. We still think they're going to cut twice, but the uncertainty is out there.
So, Sam, talk to me about what you just said a moment ago. A strong May through October offers a running start to the next November through April period. So looking beyond January, what do you think the next 4 months of 2025 are going to look like?
Well, history says, and I tend to agree with it at this point, that we would probably end up seeing investors continue to focus on the growth groups. The market has risen an average of 7% in that November through April period versus only 2% May through October. But a strong May through October leads to an even stronger November through April. What we have found is that consumer discretionary, we have found that materials, industrials, and technology tend to be the best performing sectors in that forward 6-month period. And the technicals tend to support that at this point. So I would tend to say that heading into next year could be positive, certainly if the election goes the way the market is currently anticipating.
And with that anticipation, and I know you've had several webcasts about this. I apologize, Sam. I haven't been able to tune into them. But what is the outcome that the markets are anticipating? And what is the reality as well here of what the activity is that we could see post-election? I mean, you've got Citi out here and their strategists this morning talking about there could be some selling, some heavy selling, if we did see a Trump victory. At least that's what they're telling some of their own clients.
Well, first off, I forgive you for not tuning into my webinars. I think you might have some things to be working on your own. Anyway, what I am looking at is historically a gain in the market from July 31 through October 31 has pointed to an incumbent re-election 82% of the time. One of those 2 times that it did fail, however, was 1968, very similar to what we're experiencing today in that LBJ, the president, stepped down. Hubert Humphrey, the vice president, stepped in. We had a very unpopular war, Vietnam. This time around, the unpopular war could be described as the war on inflation and immigration. We had the Fed cut interest rates that did not help the incumbent. And surprisingly, we had the conventions take place in the same city in Chicago. So will 1968 be a precursor to 2024? I think certainly that if Kamala Harris is elected, the market probably will sell off because it's built so much into the possibility of a Trump victory. If we do see a Trump victory, maybe there might be some slight digestions of recent gains, but then I think investors will be positioning themselves going forward.
Sam Stovall of CFRA. Thanks so much for taking the time here with us this morning, Sam. Always a pleasure to get some of your insights.
My pleasure. Thanks.
Coming up, everyone, Chipotle shares under pressure after reporting results. We're talking to the company's new CFO about the impact of inflation, in-store robots, and much, much more next on Morning Brief.
Chipotle's third quarter results coming in just below expectations. Revenue and same-store sales are falling a bit short, following a string of winning quarters. Taking a look at the stock right now, you're looking at shares off nearly 7% in early trading. The burrito chain seeing costs tick up, partially due to higher prices for avocados and also dairy. Joining us now, we want to bring in Chipotle's new CFO, Adam Reimer, and we're also joined by Yahoo Finance's executive editor, Brian Sozzi. Great to have both of you. Adam, let's talk about this most recent quarter. You're taking a look at the trends. They do look overall healthy, just given the macro environment, yet you are seeing that disappointment play out in the street right now with shares off just about 7%. I'm curious what you think the street might be missing here in this quarter that you are encouraged about.
Yeah, we had a really strong quarter. And so as everyone knows, we started off in the quarter a little bit soft because of the summer seasonality that we pointed out. But we saw nice steps up in August, and also September. As school kind of started to come back into session, we had a really successful launch of brisket. And then that trend has continued into October. So we're really excited about the trend that we're on right now.
So Adam, it's Brian, good to see you here. So a little bit of a brisket bounce. How much supply do you have for brisket and what's next in terms of new product introductions?
Yeah, our supply for brisket is looking really, really good. We're going to get through the end of the year without a problem. And so we've been able to secure, with the help of our supply chain team, a really healthy supply. And then what's coming up next, we haven't exactly said. We are very excited about Chipotle Honey Chicken being tested in Sacramento as well as Nashville. That made it successfully out of the stage gate process, so it's potentially on deck for another LTO, but we haven't made the decision on what'll be coming up in the spring at this point.
Do you, since Brian, I think Brian Niccol, now former CEO over at Chipotle, he was very focused on methodically rolling out new items. Do you feel more pressure to speed up the process? I mean, you're the new CFO, you have a new interim CEO at the helm there, or do you stay disciplined on some of the just the practices that Brian put into place?
Yeah, we absolutely stayed disciplined. And I kind of like this pattern that we're on of an LTO in the spring as well as one in the fall that really aligns well with our marketing as well, when everyone is really in tune with TV and the ability to have a really good splash on those. So we're going to stay disciplined. We're going to stay disciplined, especially on the stage gate process. and continue to work with that strategy in the coming years.
Adam, to what extent are you seeing any signs of consumer stress right now, especially as you think about some of the quick service restaurants that are out there, or even fast casual, that are trying to moderate their prices lower or just put value into some of their existing menu items as well? And how are you thinking about that at Chipotle?
Yeah, absolutely. I mean, we have tremendous value at Chipotle. And so as we've seen some of the QSRs and others really go into value, we haven't seen any impact in our business. So we've been pretty broad-based across all income cohorts, and our trends really haven't been affected by it. And we've also been able to maintain a really good growth in market share year over year. So I think people come to Chipotle for what it is that we offer, which is premium ingredients at a really fair price point.
And I mean, just mentioned stability across all income growth cohorts there. Are you seeing growth across all of those?
Yeah, absolutely. Growth across all of them, and that's what's contributing to our positive transactions right now.
Adam, you got and then, of course, Scott Boatwright, interim CEO, are following some OGs, some real heavyweights. Of course, Jack Hartung, former CFO, he's still with the company. But how are you two both going to lead the company differently? And how might your leadership look a little bit different than the people that you're replacing?
Yeah, so Scott, as you guys have known, been with the company for about 7 years. I've been closer to about 16 years. And I've been really fortunate to have Jack as my mentor during that time. So I think you're going to see more of the same from a financial standpoint. We have an amazingly strong balance sheet, an amazing economic model. We're able to invest in these premium ingredients, yet really have an accessible price point. And so I think you're going to see a lot of the same continue because the strategy is working, and it's been a really successful run up until this point.
Are you still on track to open, more than 300 restaurants next year? And how many of those will have drive-thrus?
Yeah, so next year we've given guidance that we're going to open between 315 and 345 new restaurants, of which at least 80% will have the Chipotlanes.
Adam, what are you seeing just in terms of the performance of those Chipotlanes versus the more traditional stores?
Yeah, absolutely. They continue to outperform. Sales are a little bit higher, margins are even higher, and so therefore the cash-on-cash returns are higher. And what's amazing about it is the digital mix is shifting away from delivery and more towards order ahead. So people really love the convenience that the Chipotlane offers.
Adam, I'm continuously blown away by these robots that you guys are really experimenting with at Chipotle here. Avocado was, I think, the newest one back in September that you had rolled out. How many human touch positions do you anticipate could be revamped or replaced by things like artificial intelligence or, in this case, just robots?
Yeah, I look at it less as, human touch and more about different procedures that we're doing in the back of the house to really make the job more desirable for our crew, improve our culinary. So, for example, with the produce slicers that Scott mentioned, it's going to help us have more consistent cut sizes, different things like that. And really what it's going to also do is drive efficiencies within our restaurant. So it's really a win-win across the board.
Do you see that ever coming to the front line where I'm speaking to a real human and I'm begging them, Adam, for just more chicken, just a little bit more chicken?
They're giving it.
Am I going to have to negotiate
for $7 more?
Do I need to negotiate with a robot in the future?
Definitely not. On the front line, we are going to keep it Chipotle. We love the experience of going through the front line, interacting with a human, seeing the food in front of you. So I don't think you're going to see that change anytime soon.
Adam, we've had some good-natured fun with Jack and Brian in the past, and we'll carry on that tradition to you. I mean, look at this new Chipotle costume for Halloween. I think you need to deal with the spirit of Halloween. So my question to you is, are you and Scott going to go visit stores and then wearing that outfit? I mean, obviously the employees couldn't see you. I mean, is that really you in that costume?
It is not me. It would be a little slimmer if it were me. However, yeah, that actually sounds like a plan. Actually, my son asked me the other day what I'm going to be for Halloween. I was like, I'm going to bring home one of those costumes. And unfortunately, we're going trick-or-treating together with me in one of those. So the neighborhood will have a good time with that.
Welcome to Yahoo Finance. And we got the new CFO, Chipotle. He's crunching those numbers, driving quarterly results, and also out there dressed up like a bag for Halloween.
What more could you
love
want?
this guy. I mean, this is good. Welcome to the squad.
Yeah, Adam,
Thank you, bro.
That'd be a totally new take on Undercover Boss here. Adam Reimer, who's the Chipotle CFO, and Yahoo Finance's Brian Sozzi. Thanks so much for taking the time.
Thank you, guys.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's go. First up, we've got Visa shares. They are climbing. The payment network beat the street's profit expectations in its fourth quarter earnings report. The beat driven by a rising number of cross-border transactions here. The company's seeing net revenue jump by about 12% year over year. And then additionally, taking a look at the full year, you're looking at that net revenue for full year 2024 up by about 10%. The company had also announced, and I don't know if this is getting a ton of attention, but partnership with Coinbase to integrate Visa Direct. So Visa essentially looking at the crypto space and saying, Lord, I've seen what you can do for others. I want that for me too. We'll see.
Certainly. All right. Well, we'll see whether or not that delivers. Let's take a look at Kraft Heinz. Shares are sliding this morning. The food and beverage maker posting a worse than expected revenue drop. Weak demand for its meal kits and snacks weighing on results. You're looking at a drop of just about 3.5%. Putting this in perspective, sales have now missed for the past 6 quarters in a row. So lots of frustration coming out from the street in terms of what executives are saying about this. The CEO saying that the sales recovery is obviously taking longer than anticipated. But he went on to say, quote, when we look at our U.S. retail sales business, we are expecting more of an elongated recovery driven by specific categories that continue to experience pressure. So maybe some of the pressure that we have seen over the last several quarters will be a theme that's sticking around here for some of the quarters to come.
Absolutely. We're also tracking Volkswagen shares here today. The German automaker reporting a 42% drop in its operating profit in its third quarter earnings report. To discuss, we've got Yahoo Finance's Pras Subramanian. I mean, Pras, shares are still up 2%. All right. So what's the big deal?
Well, the reason why is that they could have been worse. That's the reason why shares are slightly up here. So you mentioned that 42% operating profit plunge. That's down to $3.1 billion in the third quarter. Revenue also slipping from a year ago. And its operating margin fell to just 3.6%, down from 6.2%. I mean, this is the lowest they've had in 4 years. Not surprisingly, global sales in the Q3 down 8.3%. It kept its outlook that it had cut last month, so it maintained that outlook, but that had been cut throughout the year. Like I said, believe it or not, shares are up here because analysts, investors thought it could even be worse, and that's not a great thing for VW. And the company sort of also mired in tough talks with the unions. VW says it will close probably 3 plants in Germany, which is sort of unheard of for many, many years, if not 20, 30 years. That's not been the case. They've also announced they're going to close an Audi plant in Brussels where they make an EV there. So there's a reckoning here for VW, and we haven't even talked about China.
Yeah, tell us a little bit more about China and some of the trouble there.
For about 20 years, VW was the top-selling brand in China with its JV joint venture operations with other Chinese automakers. Of course, now that's been slipping tremendously, and they're under tremendous threat from local Chinese automakers like Li Auto and BYD. In fact, they're turning to other new Chinese automakers to sort of fill the gap there and try to make more vehicles that are attractive to that domestic audience. We've seen Stellantis do that too with XPeng, I believe.
You know, Pras, I wonder for how much kind of fanfare, I guess we can say, we've seen around the Cybertruck, or people just being really blown away by or jarred by the look of it. On the other end of it, you've got Volkswagen with perhaps the antithesis or the opposite end of the spectrum to the Cybertruck, which is a very friendly VW ID Buzz here. Is that gaining any traction?
You know, the VW Buzz has a nice sort of nostalgia trade here. Many people love that vehicle from the 70s and 80s, and it was like a cheap way to actually not just get around the country, but also people lived in those things. The problem with in my mind, the VW ID Buzz now is I think it's around $60,000 in the US, which is seemingly a luxury automobile, right? I mean, it seems like it's sort of out of place and, or I should say, out of touch or out of reach for many people that might be fans of that car. So I think that's an issue that VW is dealing with, is the fact that some of their vehicles are not desirable at this point for the VW brand itself, and then also maybe too pricey, and they might need to come down a bit there.
All right, Pras, thanks so much for breaking that down for us. Just about 26 minutes into the trading day, let's take a look at where things stand. We're not too far from the flat line there. You can see the S&P just barely in positive territory. The Dow up 100 points, but the Nasdaq just below the flat line. Of course, the reaction to the street playing out this morning, a slew of earnings results really driving this morning's action. We also got a couple of key econ data prints out before the bell as well. The latest reading on GDP, also the ADP print ahead of Friday's very important jobs results. Coming up next, that does it for Morning Brief, but stick with me. I've got you next on Catalyst, more analysis on today's biggest drivers. We'll be right back. Welcome to Catalyst. I'm Shauna Smith. We're 30 minutes into the U.S. trading day, and let's get you the three catalysts that we're watching this hour. First up, we hone in on big tech earnings as Alphabet's AI efforts are looking like they're paying off. While AMD does disappoint the street, we will break down what to expect from Microsoft and Meta after the bell. Plus, Bitcoin nearing March highs of $74,000 as the digital asset is viewed as a proxy of the Trump trade. Can the rally sustain itself? We will discuss. And we hone in on another top trade here ahead of the presidential vote as gold touches yet another record high. We discuss that and so much more ahead. The story of the day and the story of the week. More Mag 7 earnings on deck this week. Meta and Microsoft out after the bell today, and Amazon is set to report tomorrow. Joining me now, we want to bring in Kevin Mon. He's Hennian and Walsh Asset Management President and Chief Investment Officer. It's great to see you. So let's talk about what we heard from Google and maybe what that signals that's ahead here for some of these other Mag 7 names. One of the big concerns going back to last quarter was the massive spending on AI. It certainly looks like, at least for Alphabet, that it's paying off. Are you expecting for that to be the case with some of these other big tech giants?
It's all about AI once again, Shauna. I'm speaking at a conference in Boston this week, the IXIC Asset and Wealth Management Summit, and the focus is on AI, alternative investments, and artificial intelligence. And one of the comments I made yesterday was that I see a bigger risk in underspending in AI than I do in overspending in AI. But we do need to realize that AI is a long game. And all of these CapEx spends that are taking place aren't going to necessarily translate into return on investment for quarters, if not years to come. So continue to look for those companies that are spending in this area, have a commitment in this area, because it will benefit them down the road.
So then, Kevin, it doesn't sound like you're expecting to see any signs of exhaustion of AI spending.
Oh, no, I still think we're only in batting practice of a doubleheader right now. We're going to see more and more commitment to this space and not necessarily realize the benefits of all that spending, once again, for years to come. But I look for different areas in the AI ecosystem that are benefactors of all this spending that's taking place. One of those areas, which I think is going largely underreported, is the energy sector, specifically as it relates to utilities. All of these data centers that require tremendous amounts of energy cannot produce their own energy, at least not yet. So they have to turn to the utilities of the states that they operate within for either electricity, natural gas, or, as we're now finding out, Shauna, nuclear power.
Yeah, and Kevin, it certainly has been a switch here, just in terms of the narrative. When historically, when you think about utilities, you think of a pretty boring sector. I think that's safe to say.
That's right.
But now there's lots of excitement. We've certainly seen that played out since the start of the year. I'm curious, just in terms of the top ways then to play some of those favorite names within the utility sector, what are they?
Yeah, I would start by saying there are three tailwinds that are going to support future growth in the utility sectors, recognizing that they're having their best year to date in the last decade. But one tailwind that I see is, and you pointed out, they're more defensive in nature, and volatility has been largely absent from the markets thus far this year. So I would anticipate some more short-term bouts of volatility through the next couple of months. But beyond that, they're also known for paying a high level of dividend income. And as interest rates are forecasted to decline over the next 2 years, utilities and their dividends will become even more attractive. And finally, they become a backdoor play into the AI revolution. Three names that we like in this sector that we hold. First, DTE Energy. They got a yield of about 3.3%, a PE of only 17. Their stock's up 15% year to date. And not only do they supply electric and gas utilities to customers in Michigan, but they also own the Fermi 2 nuclear power plant. Two other names similar in that regard, Duke Energy and Southern Companies, two of the biggest utilities in our country that also own nuclear power plant and supply natural gas and electricity to their customers. One of their customers, of course, being data centers.
Kevin, give us a better idea of this opportunity, just in terms of the growth that we could see over the next 12 months, 24 months. What do you think that looks like?
Consider this, Shauna. Over the next 6 years, it's forecasted that data centers alone will draw down up to 10% of our country's entire electricity grid. 10% data centers alone. So we're going to have to look for alternative means by which to power these data centers and all the CapEx spend that is taking place in these intensive AI algorithms. So you're going to have to look at electricity, natural gas, and now nuclear power. So there's more growth ahead. So look for those utilities, such as the three I mentioned, that do have a stake in the ground as it relates to nuclear, but also have a strong customer base, strong balance sheets, and pay good dividends.
And nuclear power seems to be certainly enjoying this renaissance. We've seen a number of the larger cap tech names there really focusing on some of their investments within this space. I want to talk about that because for nuclear systems to power AI, Oklo CEO James DeWitt joined Yahoo Finance yesterday to talk about just this, what that opportunity looks like. I want to play a quick shot here from that and get your reaction.
One of the things that we set out to do in the beginning was make it easier to buy what people really want from nuclear systems. In other words, make it easier to buy nuclear power, because the clean, reliable, affordable power, that's the stuff people really want. And so the typical business model has made that real clunky. It's really chunky in its transactional process, and it's difficult. And we're unique because we actually make that easy by, we design, we own, we operate the plants, we contract someone to build them, and then we just sell the power out to the customers through offtake agreements. That makes it easy for them to buy what they want.
Are we just very much, going back to your baseball analogy earlier, very much just still in the early innings of big tech's investment within this space?
We are, and there's two ways that you could approach this, and that guess it was spot on. First, we learned that Microsoft partnered with Constellation Energy to reopen 3 Mile Island to power their own AI-oriented data centers. But then we heard from Amazon, who's reporting earnings themselves tomorrow, that they're working with Dominion on these SMRs, the small modular reactors, as opposed to opening up an entire nuclear power plant. There's different ways to peel the onion here, and I think the opportunities are endless as it relates to power-related investment opportunities. Again, don't just limit yourself to electric. Don't just limit yourself to natural gas. Don't just limit yourself to nuclear. Consider all three, and some of these utilities provide all three in one investment.
Kevin, it doesn't sound like the AI narrative's going anywhere anytime soon. We were talking so much about the fact that there are opportunities obviously outside of the Mag 7, but just in terms of that overall narrative really driving the market, it seems like that is going to be a focal point, at least for you, in 2025.
Without a doubt. And I think we need to expand the lens beyond just the semiconductors and the chips. I know we focus so much on NVIDIA, and rightly so, and Taiwan Semiconductor and Broadcom. But consider these data centers themselves, which are generally REITs, companies such as Prologis or companies such as Iron Mountain. And then remember also, Shauna, that these data centers run hot. So they need cooling solutions. And companies that provide those cooling solutions, whether it's Vertiv or Modine Manufacturing, there are also ways to play the AI revolutions. It's not just the miners, to use that age-old analogy, but it's the picks and shovels. And there are so many picks and shovels opportunities out there. But remember, and this is my final closing comment, there's going to be a lot of winners in the AI revolution, but there's going to be even more losers. So try and avoid those potholes. Look for companies with strong balance sheets and commitment to the space, and those that are spending in this area to reap the benefits down the road.
Great advice there. Kevin Mon, always a pleasure to speak with you. Hennian & Walsh, Asset Management President. Thanks so much.
You're welcome.
Some breaking econ data crossing the wire. Pending home sales data showing a 7.4% rise on a month-over-month basis in September and a 2.2% rise on a yearly basis. That was the highest level that we've seen since March. All 4 regions showing month-over-month gains in transaction activity. And breaking that down even further, we saw the most gains in the West. That was up 9.8% on a month-over-month basis, followed closely by Midwest. That was up 6.1%. The South and Northeast regions were also up well above 6% level. So again, some strength there across the board in all 4 regions. NAR's chief economist Lawrence Yun saying in this release that contract signings rose across all regions of the country as buyers took advantage of the combination of lower mortgage rates in late summer and more inventory choices. So it looks like things might be a bit improving here for the housing market, at least for now, off of this one reading. Of course, it has certainly been mixed here over the last several months. We had a couple of home builders up there on the screen. We are looking at some gains across the board today. Coming up, Meta and Microsoft, the next in a string of Mag 7 earnings this week. We'll discuss what to expect next. Two more Magnificent Seven companies reporting after the close today. I had a chance to speak with Nancy Tangler, the CEO of Laffer Tangler Investments, about expectations for Microsoft. Here's what she had to say.
I think we're going to be focused on, Azure, as is everyone else. Is it going to continue to accelerate? It did last quarter, and they got nothing for it. We're going to be looking at margins, and then, just the guidance for the future, because I think, they announced their CapEx budget. Wall Street didn't like it. Wall Street analysts don't run businesses. Satya Nadella does, and my money's on him. So I think we want to hear the monetization of the AI. Just forgot the name of it. Their AI chatbot and Copilot. Sorry, and we will see how that is going, because that's the criticism on AI, is that it has not been monetized.
Nancy, that happens to me all the time, so don't feel bad at all. When it comes to the performance that we've seen from Microsoft stock since the start of the year, we're looking at gains of just about 14%. Now, that far underperforms what we've seen just in returns here compared to the broader S&P 500. Is this earnings season, is that going to be the catalyst to really get Microsoft back on track?
No, Shauna, I think largely it will probably be driven by Azure and monetization of AI. And so if they give good guidance on that, I think the stock will have an opportunity to appreciate. We were adding to it right before the new bull market started at $200 a share, $214, $215. And that's a great generational opportunity. So it also matters, of course, where you got in, how patient you're willing to be. But they're growing the dividend 10% a year, even though the yield isn't super high. You get that growth as an offset against inflation, and so I think you can be patient. We'll see. They've when they report, they usually outperform the majority of the time after the report.
Meta, another name that's set to report tonight after the close. An outperformer over the last 3 months, you're looking at gains of just about 30%. Year to date, you're looking at gains of nearly 70%. Mark Mahaney is a senior managing director and head of internet research at Evercore ISI. I asked him about how investors may react to Meta's CapEx spend on AI this quarter. It was a big issue last quarter. Let's hear what he had to say.
I think fundamentals are well intact with Meta. Is it actually the best performing of the Mag 7? I guess it probably is. I don't know. Probably not with NVIDIA, but I don't cover some of the other names. But in the internet space, the fundamentals have been amongst the most and probably the most impressive in the advertising space. I mean, especially at their scale, they're doing well over 20% revenue growth. That is truly impressive. I think there's a lot of kind of untapped areas, Threads, click-to-message ads, WhatsApp, Facebook Marketplace, that they can still kind of lean into to sustain what I would call premium growth, mid-teens, maybe even high teens over the next couple of years. Margins are rising. So the expectations are high for this stock. I think they'll be able to deliver against them. I like the stock. It's not one of my top picks because it's not that dislocated right now. It's not dislocated at all. It's probably the most consensus long in large cap internet. But maybe the one trick or one thing, if the stock were to trade off, it would probably be because the company were to surprise people with a really aggressive CapEx outlook for next year. I think that's a possibility. I don't think that's the probability, but I think it's a possibility that happens.
Well, and given that Meta has found a lot of success by being really defensive on the balance sheet, I wonder, too, what you think we're going to learn about their expenditures when it does come to AI. Do you think that we will get any indication about any ROI on their AI spend this cycle, or will we have to wait?
I think we'll get it. I think we've gotten it. The last 2 years, if you look at the ability of this company to recover to almost 30% ad revenue growth, that came because of AI. They used AI to rebuild the user interface to make it more of a media platform rather than a social platform, and they used it to dramatically improve the ad targeting, campaign management, ad creative for marketers, and that's why Meta right now is perceived to be kind of the easy buy amongst marketers, amongst advertisers. I think they'll be able to give you more and more data points that prove that they've been able to effectively, with a good ROAI, that they've been able to effectively invest in AI, which is one of the reasons why I think they've been so successful with it, that I think they may well decide to even more aggressively lean in I don't think any of these major internet tech companies, the big ones, Amazon, Google, and Facebook, Meta, I don't think any of them are going to step back and say, hey, we're cutting back our AI capex. They're either going to keep it where it is or they're going to accelerate it even more. And that could be a little bit of an issue for investors.
Coming up, we're taking a look at shares of Supermicro. Look at that drop nearly 30% to the downside here. We'll discuss why when Catalyst returns. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's what the Yahoo Finance's trending tickers page. Josh Schaefer, he's back for round three, so let's get to it. We've got four stocks actually, for you today. We're really putting you to work here on your third day in a row with us. All right, let's kick it off with Supermicro. Supermicro Computer plunging after Ernst & Young resigned as the company's auditor. That's according to a securities filing. This follows months of disagreement over the company's governance. Ernst & Young saying in a letter that it was unable to rely on management and the audit committee's representations. Now, Supermicro saying it disagrees with that decision. You're looking at a loss of just about 27% in today's trading. The stock had been briefly halted earlier trading due to volatility. But of course, when you take a look at this, the significance of this, what this ultimately means here for Supermicro going forward, it could, I guess, reaffirm or confirm maybe some of the suspicions that we saw in that short seller report not too long ago.
Yeah, so Hindenburg Research in August came out with a report, right, that high level essentially accused them of some sort of accounting fraud, some sort of accounting errors. You then spin that forward 2 months later, and one of the largest accounting firms in the U.S. dropping them and saying that they don't essentially trust what's going on there. It's not a good read, right? And I think the market is giving you a very clear read on how they feel about that today, with Supermicro shares down almost 30%. And you remember back to that Hindenburg research report, I don't remember the stock necessarily tanking right off that report to this level. It seems like you're starting to get confirmation now of, okay, Hindenburg said this. Hindenburg comes out with a lot of short reports, right? And they take a lot of short positions. But this gives perhaps a little more credence to that. Still a lot to be played out here. Perhaps hearing from Supermicro a little bit more on this would definitely be interesting. But of course, the DOJ also opened up a probe, according to the Wall Street Journal, at the end of September, right? So you have that in play. The Wall Street Journal have reported that the DOJ was looking to speak with a former employee who was accused of making accounting errors while working at Supermicro. So it seems to be, as you put these pieces together, it seems to be there's maybe a little bit of something here.
Yeah, what's interesting here is EY's concerns apparently were raised here prior to that short seller report that took aim at Supermicro here. They're saying that the auditor first flagged these issues going back to late July, and that prompted the server firm here to then appoint that special board committee, the internal investigation committee, or the investigation into the company's internal control. So again, this has not long been, but over the last several months, obviously has been an overhang here on this.
And EY was working on their full year 2020, or on Supermicro's full year 2024 report, right? Their filing, they delayed that filing in August. From what I see on the webpage, that filing still doesn't exist. That 10K is not out. And so the question here is, are they able to get another auditor, right? Who do you bring in to audit that 10K? How does that process work? And do you eventually get this thing through the door? I would imagine there's probably an overhang on Supermicro shares here until you get more clarity on it.
Yeah, exactly. And the Supermicro saying that they're working to identify a new auditor. But again, the question is who that auditor is going to be and when we will get further clarity on that. All right, next let's talk about Chewy. It's a meme stock influencer, Keith Gill, known online as Roaring Kitty, dissolved his stake in the pet products retailer. Gill had a more than 6% stake in Chewy as of June. That was according to a previous SEC filing. So again, getting rid of or selling his stake within the company. It is important to point out, now, Roaring Kitty has very much been associated with the meme stock trade. So when you think of meme stock, you think very much of his involvement with GameStop. If you're familiar with Roaring Kitty, I think that's clearly the first stock that comes to mind. Obviously, some of the other names that have been caught up in the meme trade. It is important to point out, though, that the trading pattern, when you take a look at a longer-term chart of Chewy, has been very different from some of those meme stock trades, right? So it is important to point that out, but obviously just his involvement has attracted some of those retail investors to the stock. And again, you got to wonder how significant this is on an intraday basis. You're not looking at a huge move.
Props to Keith Gill for owning enough of a company that he has to have an SEC filing, right? I mean, that's one just sort of fun takeaway from this. I think from a market perspective, just enjoying watching some of these moves, the fact that he owns enough of a company that it's required to put an SEC filing, these exiting positions, shows how big these positions have got for Keith Gill, right? But I do think, Shauna, you make an interesting point. If this was GameStop and he exited his position and that news came out after the bell yesterday, the stock would be moving. The stock is not moving because there is an actual investor story with Chewy that people have bought into here, and people weren't necessarily buying this stock just to make a meme trade out of it. And I think that's probably the biggest takeaway I would have on Chewy overall today is good for Chewy that it's not getting influenced by this meme madness, and Keith Gill leaving doesn't mean that it actually hurts the fundamental story, which, as you pointed out, year to date has been going quite well for them.
Yeah, exactly. Certainly, we have seen a turnaround since the slump that we saw in 2023. So again, when you take a look out also at their guidance, that of course will be key at that next earnings report. Take a look at Caterpillar, missing third quarter estimates hit by weak equipment sales as demand falls. The company also cutting its annual sales forecast. We obviously look at this as an economic barometer to some extent of maybe what this tells us more beyond in terms of that macro spend and where we are seeing some strength and or weakness here within the economy. Construction equipment sales, that fell 9% from a year ago. The company seeing 2024 sales and revenue slightly lower than it had expected. Of course, that's contributing to that about 2% drop that we're seeing in sales today. Now, Caterpillar very much viewed as that bellwether, like I just said, muted economic conditions in industrial sectors throughout the third quarter really provided very little positive momentum momentum for the stock beyond some of the headline groups that have been able to outperform. Is something that Jefferies called out in their note here this morning in reaction to this. So again, weighing on the broader market to some extent. You look at Caterpillar, you can see the drop here today on that 5-day chart. But again, not too big of a decline to the downside here, off just about 2%.
No, and it was the second straight quarter, I believe, that they actually trimmed that revenue guidance. I think they trimmed it back in August, then trimmed it again today. So it makes sense to see a little bit of weight on shares. Also interesting that they called out inflation in this call, saying that prices remain high. That's been a headwind for them. But I think overall, when you talk about it as an economic barometer, some of the machinery that Caterpillar sells would probably be in that manufacturing sector that has been in contraction largely for over 2 years, right? So I don't really know if that's a fresh read necessarily on the economy, and maybe it's not that big of a worry. That's what a lot of economists have been saying when you get different reads on the manufacturing sector right now, when PMIs come out every month and they're weak again. Well, we just keep seeing it weak. We've been seeing it weak for 2 years, but the economy's still growing. So how much does that matter? I think people sort of argue about that, but the prevailing take seems to be maybe not as much from a macroeconomic perspective. But Caterpillar stock, again, something I keep bringing up with these earnings, it's done pretty well this year, right? So to see a little bit of a hit after rising over 50% over a year, that's just kind of how earnings work, right? If you disappoint the street on certain metrics, on sales metrics, as we talked about yesterday, right? Highly in scrutiny right now, your stock's gonna take a little bit of a haircut, but only down 2%. Really, I would probably argue actually not bad.
Yeah, and I think also just looking ahead to the guidance in 2025, talking about those macro issues, not expected to really change much or really move the needle here between now and then. So again, some of the issues, some of the overhang here on the stock that is causing a bit of a disappointment here this quarter could be likely then to continue as you look ahead to 2025. Let's take a look at Robinhood, set to report third quarter results after the closing bell today. Investors will be looking for more details on the company's new products and tools that was unveiled earlier this month. I know you were at that. Was that the unveil that you were at?
Yes. Okay. So I went to Robinhood a month ago and talked to them about some of these new products. So they launched futures products. You're now able to trade something like oils futures on Robinhood's product. They also announced a new sort of trading setup. So their website shifted now where you can basically create a screen with 5 different screens, so you can throw up 200-day moving averages, run technicals. Interesting part of that is you can trade in essentially every screen you're on. So if you're looking at, say, Apple stock, you can press buy and put in where you want to buy it on the chart, which I thought was pretty interesting, but they feel like that's going to drive more engagement, also going to just drive more people to the platform to stay. The big thing when you talk to Robinhood management, as I have over the past couple months, they feel like they've grown this investor base of what a lot of people titled retail investors over the last couple of years. And now the question is, how do you keep them and grow with them, right? So offering them new products like futures, options, potentially 401ks. When you start to build out that whole platform, you just become a more competitive part of the market. And I think their stock has reflected that. I mean, the stock has ripped over the last year as earnings have started to grow, revenue doing better. Like the overall story has just grown for them. So it seems like maybe expectations slightly high going into that print, I guess, would perhaps be the read there. But it has done very well so far, and the market has accepted it.
Yeah, done very, very well. You're looking to stock up over 120% year to date. Again, those results coming out after the bell today. Josh, back tomorrow, maybe? We'll see. All right, coming up next, a look at Bitcoin's latest rally and other trades ahead of the 2024 election. That's next on Catalysts. Bitcoin holding just above 72,000 after nearing an all-time high on Tuesday. The cryptocurrency building on its recent rally as bullish bets surge ahead of the 2024 presidential election. So much further can the rally run, and also what might derail it? Let's talk about that with Matt Hogan. He's Bitwise Asset Management Chief Investment Officer. Matt, it's great to have you here on set. So there certainly has been this excitement playing out on the street right now when it comes to Bitcoin, this march higher. Let's talk about the tie-in here with the Trump trade. How much of it has to do with the higher odds of a Trump win next week?
I think the most important thing for Bitcoin is that the election happens. Regardless of a Trump win or a Harris win, the regulatory setting for Bitcoin is improving. And I think that's what you're seeing reflected in the price. Of course, in the short term, crypto favors a Trump victory over a Harris victory. But really, Bitcoin doesn't need Washington to succeed. Regardless of what happens, institutions are moving into the space, adoption is rising, ETF flows are happening. I think we go higher either way. It just might be a little bit faster under a Trump.
Yeah, and when we talk about that, maybe a clarity from a regulation perspective, right? How much of that is necessary in order to continue that momentum, even potentially past 100,000?
Yeah, it's a great question. Look, I think we're going above 100,000 on Bitcoin. I think the regulatory clarity you're talking about actually matters more for the so-called altcoins, for Ethereum on down. Those are more exposed to regulatory risks. So I would expect an altcoin rally, even more so than a Bitcoin rally in the event of a Trump win. But regardless, I think both are moving higher.
Why does it matter as much for Bitcoin?
Yeah, so Bitcoin has more regulatory clarity than Ethereum and other assets. The SEC, the CFTC have already declared it a commodity. It's in the clear. There's already an ETF. BlackRock already has a huge business in that. That's not as true for Solana and Aptos and other altcoins, but I suspect if we get a new SEC, that will become clear, that will drive institutional adoption, and we'll see that rising tide lift all of those boats.
What then do you think is the number one catalyst for Bitcoin as you look ahead to some of your 2025 projections?
Look, I think this is the best single time to invest in Bitcoin from a risk-adjusted perspective. All of the major existential risks of Bitcoin have been washed away. We have an ETF, we have institutions, they are coming into the space. The biggest catalyst is that move of institutional adoption. We're seeing that accelerate. We saw $800 million in ETF flows yesterday alone. This is a tidal wave of institutional assets moving into the space. There's a fixed supply, and from my perspective, that means higher prices.
And you're saying it doesn't matter ultimately in the long run who is elected come next week. I'm curious then, because there's been so much talk about why Trump is better for Bitcoin or for the crypto community than Harris. It seems like at least in the short term, maybe that is the case. But why are you confident, or I guess why aren't you as concerned about the pullback that we could see if Harris is elected?
Look, I think we could see a short-term pullback, but in that case, I think it would be a major buying opportunity. That's right, specifically for Bitcoin. For those altcoins, I think there's more regulatory uncertainty. But Harris has already indicated that we're likely to turn the page, and I think Washington is ready to turn the page on crypto. You see bipartisan support for crypto bills. You see talk about moving on from the SEC. Make no mistake, short term, the rally is higher on crypto if Trump wins, and I think it's more certain we'll get that regulatory clarity for the altcoins. But in either case, I think the direction of travel is upwards. I think we'll be at new all-time highs this year on Bitcoin, and I think 2025 will look even better than 2024.
What more specifically does that look like?
Look, we're going to six-figure Bitcoin. We're going to $100,000 plus next year. We're working on our price target for what we expect in 2025. We may release that next week. But if you step back and look at it, crypto has moved from the niche to the mainstream. You have Emory University allocating. You have 60% of the largest hedge funds allocating. We've jumped the chasm. We're going mainstream, and that means higher prices.
When it comes to the biggest challenge, or maybe not the biggest challenge, one of the challenges, one of the overhangs when it comes to crypto is just the uncertainty surrounding it. I think maybe some of the more traditional investors are a bit cautious when it comes to crypto, just given its reputation. What do you think is the biggest misconception when it comes to crypto?
Yeah, I still think it's the original misconception that it's a cryptocurrency and people expect you to buy coffee with it. Look, I've never bought a coffee with Bitcoin, and I think it's the most important financial innovation over the last 30 years. But this is just a matter of time. The flip side of that lack of understanding, which is a risk, it drives volatility, is that's also the opportunity. That's why Bitcoin is up 10,000% over the last 10 years, because people have realized what it is and what it means to the world, and it's why I think it's going higher still.
Do you think the institutional involvement here that we've seen through ETFs, that we've seen through funds, really obviously pick up over the last several months, is that pretty much erased this confidence problem that crypto did have, just given what had happened in the past?
Yeah, I think, look, it's moved it from something that people weren't sure would be around, would matter, into something that people are certain will be here. And now the question is it a $2 trillion or a $10 trillion or a $20 trillion asset? So it's sort of showed that Bitcoin has gone from 0 to 1. It's not going back to 0, and now it's a question of how high it goes from here.
What's going to be those deciding factors?
Yeah, look, I think the number one factor is, does the government continue to build up debt and abuse the US dollar? Bitcoin is ultimately a release valve from a government that has $36 trillion in debt, is adding another $1 trillion in debt every 90 days. One of the reasons I said the election, doesn't matter long term is the only thing we can agree on as a country is piling on more debt and doing more spending. We see no one talking about pulling that back. So that is ultimately the long-term driver. The education process, the building up of debt, you add those together and you're talking about a much higher price.
The best way to play it, I think that's what a lot of investors are trying to figure out. Is it through ETFs? Is it through buying actual Bitcoin? What would your advice be?
Look,
or how should investors maybe be thinking about
Yeah,
that?
absolutely. I think both are extremely valid. Buying and holding self-custodying Bitcoin is the original OG way of doing it. We see a lot of value in that. But ETFs are the easiest, cheapest, and safest way for many investors to do it. That's why we've seen the flows. Look, the beauty of ETFs, not just Bitcoin ETFs, is they allow retail mom and pop investors to access investments on the same term as the largest institutions in the world. You can do that with our ETF, BITB, for 20 basis points. Qualified custody, that's an incredible deal. We'll see people do both, but I think you'll see a lot of flows into these ETFs.
So it sounds like it's not really much a question of if, but more when we're going to see those new all-time highs here for Bitcoin and then beyond. All right, Matt Hogan, great to have you here on set. Thanks so much for joining me. Chief Investment Officer of Bitwise Asset Management. Bitcoin and gold slightly ticking to the upside here today as investors try to hedge election bets less than a week away from the presidential election. To discuss what sectors stand to benefit under each presidential administration, we want to bring in Eric Ditton. He is the Wealth Alliance President and Managing Director. Eric, it's great to have you here. So let's start with the Trump trade, because that certainly has been front and center, at least this re-excitement that we certainly have seen play out on Wall Street. I was just speaking to Matt Hogan over at Bitwise just about some of that excitement playing out within the crypto market. So let's look elsewhere. When you see the run-up that we've seen in gold and some of these other trades, does that have further to go?
I think gold, probably Bitcoin as well, have further to go because we just don't have a plan as a country to deal with this 35 trillion in debt and growing. And we're listening to both candidates, and I haven't heard any talk about any kind of reduction in spending. There is no plan. And forget about the stock market. The smart money is in the bond market. So here we had the Fed cut rates 50 basis points, and everyone said, great, here we go. And what happened? In the next month, the 10-year Treasury yield rose 50 basis points. And that's telling you that the bond market, that's the smart money, that's institutional money, is concerned. It's not buying in.
So, Eric, what is the top trade if Trump were to win next week? What's the top trade then for investors?
Well, it's not bonds.
Yeah.
I'll tell you that. But look, you've got to be pretty juiced up about the economy. Certainly domestic retailers, if we're talking about tariffs, domestic retailers look good. I think fossil fuels, traditional energy will breathe a little sigh of relief. Financials certainly look good. I think financials and utilities, honestly, stand to benefit under either candidate. And then, of course, the traditional gun stocks, prison stocks, et cetera. But definitely the more economically sensitive companies stand to benefit from things like corporate tax cuts.
You know, Eric, I'm curious to
like that.
Eric, I'm curious to get your thoughts just on one candidate being better than the other for the stock market. We've talked to a number of strategists, and I think consensus is maybe Trump would be slightly better than Harris. Do you share that view, and why or why not?
Yeah, forgetting about political feelings. When you have a candidate that says, I want to bring down the corporate tax rate, I want to cut taxes, certainly that's music to the stock market's ears. That's just more corporate earnings. Now, there's a song called Watermelon Sugar High, and you can have that sugar high and the stock market can do great for a while. But if we're talking about another $7 trillion in debt at the end of 5 years or however long it's going to be, at some point, that's a problem. No one knows where the tipping point is. But at some point, the market is just going to say, the bond market, you've got to pay me a lot more yield to keep buying those bonds. Mm-hmm. And we just had a weak 2-year auction. So I'm not saying it's happening now. I don't think we're at the tipping point. Japan has 255% debt to GDP. We're at 125%. All I'm saying is the markets are looking and they can't see any plan to tackle this debt.
You know, Eric, there has been more and more talk about that. Yeah, it doesn't seem like, more broadly speaking, voters don't, it's nothing new there. Voters don't seem to obviously be prioritizing this. But even from a market's perspective, to some extent, some of that doomsday scenario hasn't certainly been priced in. At what point do you think it becomes a more serious issue then for Wall Street?
I don't think anyone knows the answer to that question, Shauna. We just don't know. It's not today. We're not there. But we know that we're spending more on servicing debt now than we are on defense at a time where we really need a lot of defense spending. So we're starting to crowd out investment. We're feeling that pain. It's another reason why the Fed really wants to cut rates. We'd like to bring those rates down and bring down that debt service. So I don't know that there's anyone out there that knows where the tipping point is. But, you know, we have a problem with the system. Who is going to vote for a candidate that says, listen, I'm cutting spending, you know, all those things you love, all those benefits, I'm cutting them and I'm going to raise taxes. That candidate has no chance of winning an election. And so right now it's marketing. It's who can give the voter the most. And we'll see if that actually happens after they get elected.
Yeah, certainly, and that's why we haven't heard really either of the candidates obviously talk about that, prioritize that within some of the plans that they've put forward. Eric, real quick, before we let you go, we've talked a lot about what a Trump presidency ultimately or could potentially mean for the market. A Harris presidency, real quick, how should investors be thinking about that for their portfolio?
I think probably the best play on a Harris presidency is healthcare. Harris really wants to greatly expand Medicaid, Medicare benefits, and I think healthcare is just the easiest, obvious trade there.
All right, Eric Ditton, it's always great to have you here on Yahoo Finance. Thanks so much for joining us. Wealth Alliance President and Managing Director.
Thank you.
Coming up, we are taking a deep dive into what industries retail traders are watching. Stay tuned. You're watching Catalyst. With earnings season in full swing and the U.S. election just under a week away, we're taking a look at how retail investors are managing their portfolios in the market. Joining us now, we want to bring in James Castoulias. He is Managing Director and Head of Trading Services at Charles Schwab. It's great to have you here. So, James, let's talk about some of the positioning right now and focus first on earnings. We're in the middle of Mag 7 earnings right now. I'm curious what the risk appetite has looked like from retail traders when it comes to the AI trade.
Yeah, thanks so much for having me. I think I'd say two things. We look at trader sentiment via surveys, and we look at actually trading activity via the Schwab Trading Activity Index. And certainly recently, we've seen traders take risk off and take some profits home as well, with sort of selling in tech net in September and the early parts of October. And I think as a lot of your commentary recently around sort of the election, we're seeing clients who view it sort of more as a risk than an opportunity and getting a little bit more conservative here versus aggressive heading into the election.
And James, real quick, before we get into some of maybe those election plays, when it comes to the Mag 7 concerns, is most of it, and it's hard to tell exactly what retail traders are driving some of those decisions, but do you think it's more valuation based, or is it maybe just a bit of a more rotation trade that they're seeing opportunity elsewhere?
Yeah, probably a little bit of both. I do think the valuations are perceived to be high. I think we saw some rotation into fixed income in September as well. I also think what our surveys showed is a lot of a big delta in terms of where our traders are relative to rates. Usually you'll see maybe a little bit of sort of back and forth on, will it be a quarter, will it be zero, would it be 25, would it be 50? Our most recent survey would tell us that, traders are sort of split from 0 to all the way up to 100 basis points over the course of the rest of the year. And so I think that's sort of all playing into the perspective on a little bit of rotation out of technology, and obviously that would be the Mag 7.
And James, when it comes to the election, what are some of the risk management strategies that you're seeing traders employ? Maybe what that signals about what's ahead?
Yeah, again, I think the rotation into fixed income, certainly the rotation away from technology. We do see clients who are telling us they're interested in moving money back into the market, but typically we see a pretty high correlation in our trading activity index vis-a the S&P 500 moves and our clients net buying and selling. I think in September and into October here, we're actually seeing a divergence there, which tells us that clients are, again, more interested in taking risk off than putting risk on right now heading into the election. I know you just had Matt on, you were chatting a little bit about Bitcoin. It's interesting as well, sort of the client perceptions in that survey of where they think Bitcoin's going to go are also pretty equally split, as sort of 25-ish% bullish, 25-ish% bearish, and sort of 50% saying, I really don't know. So I think there's a lot of uncertainty right now, and what we're seeing from our traders is not sort of being off to the sidelines, but certainly not trying to leg into putting on more risk heading into the election here.
James, is there an outlier this time or this year compared to past elections, just in terms of some of that trading activity or risk on versus risk off preference?
I think maybe the outlier that I would say would be sort of the true uncertainty, both probably around the actual outcome and the implications of whichever way the outcome were to ultimately go. And so typically, I think you'll see people with sort of stronger positions heading into previous elections. And right now, the client's a bit more wait and see than I've seen, honestly.
The other big driver for the market that we haven't mentioned, the third big driver, will be potentially more rate cuts here from the Fed. Of course, we have the FOMC meeting following the election next week. What are traders on your platform currently pricing in?
I'm sorry, what was that? What are traders currently what?
Pricing in for a rate cut, just the odds that we will get a rate cut next week.
Yeah, and I think it's kind of split, quite frankly, which is really pretty interesting. And so I think some of the things we're seeing our clients rotate into are a bit more defensive. So most bullish right now, energy and utilities. Tech is always sort of a bullish one for us, especially with where we are with AI, although that did also sort of come down in September. So I think the plays right now are honestly sort of kind of split right now.
All right, James Castoulias, great to have you here of Charles Schwab. Thanks so much for taking the time to join us.
Thank you.
Just about 90 minutes into the trading day, we're still looking at not too much movement for the three major averages, although we are right around the highs of the session, at least for the Dow up 141. You've got the S&P up about 0.1%, the Nasdaq holding on to gains. Coming up, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. I'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, earnings season and your portfolio. We delve into the magnificent seven: Alphabet, Tesla, Meta, Microsoft, Amazon, Apple, and last but certainly not least, NVIDIA. Should you add more of it to your portfolio? That's the big question. We're going to discuss that. And putting your money overseas. We'll get one portfolio manager's take on whether or not you should be making international investments, particularly in Asia Pacific and China. Plus, Plus, the rate that workers quit their jobs in September declined from the prior month. We'll talk to a career coach about the best time to search for a new job. But first, we take a look at some of the market action. We are 90 minutes into the start of today's trading activity. And we're taking a look here on your screen at the major averages, the Dow, the S&P 500, and the Nasdaq, all holding on to slight gains right now. And zeroing in on the Magnificent Seven, Alphabet leading some of those tech stocks higher after beating expectations in its latest results. We hear from other Magnificent Seven companies after the close today. You've got Meta Platforms and Microsoft. So, big question. Is now the time to add those names to your portfolio or add to your current position? Joining me now, we've got Vance Howard, who is the CEO and CIO of Howard Capital Management. Vance, let's begin there. If people have already been and investors have already been perhaps doing some dollar cost averaging into some of these names already or have amassed positions, is it time to add on to them, especially knowing now that we've gotten through some of those Mag 7 names and some of the other bellwethers still set to report?
Absolutely. I think you should be adding to all the Magnificent Seven right now. They're the most interesting part of the market. They're generating money. I mean, they're making a ton of cash and moving higher as the market moves higher. So we're very bullish on the Magnificent Seven. I think Alphabet's earnings and news yesterday was very encouraging, especially for AI. So I'd be quite bullish on all seven. I'd be buying into them.
Even Tesla?
Even Tesla. I think Tesla had a really nice pop there. I think that the numbers that they came out was reasonably impressive. So, everybody worries about these Magnificent Seven, but they are leading this market higher, and they're creating some of the most interesting and dynamic products and services, and they're just ginning money. They're making money, hand over fist. So how do you not invest in the Magnificent Seven? And Brad, I always kind of make the joke. I like Procter & Gamble. I think they're a wonderful company, but are they really going to make the most exciting bar of soap next year? And I don't think they are. So
if it keeps me clean, it better be exciting here. At the end of the day,
right.
one of the major items that people think about with the Magnificent Seven is the thesis, the theme that's really played into some of these companies, some of which used to be part of the FANG narrative, which was high growth internet. But now so much of the narrative around the Magnificent Seven is really centered around artificial intelligence. And so with that in mind, how much more long tail do you believe there is to generative AI, and where are we at in the spending cycle from your perspective?
Where we're at with AI is we're on the very first, on an 18-hole golf course, we're on the very first tee box, and we're just starting to tee off on the very first hole. That's where we're at with AI. That's how much distance that we have to go and how much can be accomplished. And when you look at what Alphabet did yesterday, AI is really driving their traffic, especially their cloud traffic. And I think they're sort of leading the way with that, especially with Meta and Microsoft. They'll be coming out with earnings today. But I think there'll be a catch-up game as far as other technologies coming into the AI space. But that is an incredibly interesting and exciting spot of the economy and what's happening in the market as a whole. So I'd be incredibly bullish on AI.
All right, a lot of companies hoping that they just don't card a double bogey on that first hole. Other catalysts moving the markets here today is economic data here. GDP for the third quarter showing that the economy grew at a slightly less rapid pace than expected. Private payrolls for October came in much higher than expected as well, hotter than expected there. Investors pricing in a 25 basis point rate cut ahead of Friday's jobs report here. I want to get your reaction to the economic data that we've seen over the course of this week and how that should also kind of weigh into and be prioritized by investors right now.
Well, I think what happened this morning, I don't think anything was bad there. I think it was reasonably good. Unemployment was jobs were created. We're looking strong on the employment front. The inflation numbers starting to drop down to the Fed's target. So that's a very positive news. One thing that we are looking at though, Brad, is you look at interest rates, especially the 10-year and the 20-year, they keep marching higher even after the Fed dropped 50 basis points. So you sort of have to ask yourself, why is that? And we see that for two reasons. Number one, I think people are getting more and more concerned about the national debt. It's just exploding, and that's going to have to be dealt with. But number two, the economy continues to be resilient and strong. And so, maybe these interest rate cuts from the Fed are going to be stalled a little bit.
Yeah, and we know neither party has really made a dent in the national debt. And since that has come up, the election is another key catalyst for the markets in the next week here. I mean, how are you advising clients to position themselves at this time?
buckle up. And because just buckle up, because I don't know what's going to happen, neither does anybody else. But I can tell you this, our proprietary indicator, the HC on byline, which is a trend indicator, is positive. And it's very strong, by the way. So we're not concerned about it. Any volatility, I think, will wash through the system reasonably quick. And I think that you're going to have a powerful market after the election moving into November and December. So I think that people should be very encouraged. There's a tremendous amount of cash on the sidelines. If you go to the Federal Reserve's money market webpage, the St. Louis one, I think they've got 6.5 trillion just in money market. And if rates start to drop, which, even though we dropped them 50 basis points, they've still been, staying high. I think you're going to see a lot of that capital come out of money markets and into equities, which will push the equities market even higher at a pretty fast pace.
All of these things considered here, what type of economy should investors be positioning their portfolio around? I mean, even as we had looked through the ADP employment report this morning here as well, job growth strong in October. Naylor Richardson, the chief economist over there, saying, and as we round out the year, hiring in the U.S. is proving to be robust and broadly resilient. This is not the first time we've heard that word resilient. Resilience has continued to show up in some of the consumer data that we've also seen too. So what type of economy should investors really be trying to position their portfolios around?
Well, I think people should be incredibly positive about the economy. And I mean, we've got a good economy. Inflation's dropped, unemployment's low. I mean, the economy's churning ahead. I think you got a wonderful stock market too. And I think you've got a lot of companies that are making a lot of money. I think key things that we need to look at, number one, is who's going to win this election. Hopefully gridlock takes place. If we can get gridlock, I think everybody wins. But, I think raising capital gains would hurt the market. I think that'll slow down earnings to different corporations. And again, I think it'll slow down the overall growth of what's going to happen in our economy. So I think raising capital gains is very much a negative. So let's hope that doesn't happen. But there's a lot of different factors in play here. But I think a gridlock, a Senate and a Congress might be the best answer to our problems that we have going forward into 2025.
Vance Howard, who is the Howard Capital Management CEO and CIO. Vance, thanks so much for taking the time here with us today.
Thank you, Brad.
Certainly. Coming up on Wealth, everyone, are you looking for ways to diversify your portfolio? You may want to consider investing in international markets. We're going to break down just how after the break. Meta is releasing quarterly results after the bell today. Investors closely watching how investments in artificial intelligence are paying off for the tech giant. To discuss, we have Yahoo Finance's very own Rochelle Akufo. Hey, Rochelle.
Hey, Brad. So as you mentioned there, Wall Street wants to know how Meta's AI spending is paying off, and of course the long-term vision for AI in this crowded space as well. Well, I interviewed Daniel Diesenroth, he's the Director of Economics and Policy Research for Meta, as part of a panel of fiscal policy and Gen AI during the IMF World Bank fall meetings. Now, I asked how he viewed this rush to regulate generative AI's risks and opportunities, including when it comes to competition policy. Take a listen.
In terms of AI itself, what I see right now is what appears to be a very competitive kind of situation where nobody's making any money. And that's sort of a challenge for all of the big companies. And when I say all of the big companies, I mean there are many of them and there are many small and medium players in this space. It's also hard for me to think about what is the definition of the market for AI itself, because AI is not a product. It's sort of like thinking about the market for algebra versus the market for calculators, if you will. I also think about some of the strategies that companies are adopting and open sourcing for foundation models in particular. As Carl had alluded to, open source technology lowers barriers to entry, encourages competition, particularly among smaller players. And so from a harm to competition itself perspective, I think that open source is actually a really good thing. And then on the consumer side, by encouraging this level of competition, what we see is a much more rapid rate of innovation and development of the technology itself.
So it goes to show that while the consumer is the focus, especially when it comes to automation, the conversation has really shifted away from predictions of AI wiping out entire industries to some of these more incremental improvements. And now we're looking at strategies that companies are honing in on when it comes to innovation. He gave an example of an experiment that Meta ran using targeted ads on their platform versus using AI targeting. Now, when they compared the revenues, the AI targeting saw about a 22% increase versus the targeted ads. So it's interesting. It gives this idea that AI may know your customers better than you do. And it certainly shows some of these broader gains that Meta is really looking at when it comes to AI, Brad.
All right, a lot to keep tabs on when the company reports earnings. Rochelle, thanks so much. Appreciate it. Well, China is considering approving $1.4 trillion in extra debt in the next few years to prop up its economy, according to a Reuters report. China's economy has largely failed to bounce back post-pandemic, and officials have announced and are weighing a number of stimulus efforts, including this latest debt proposal. Chinese stocks have picked up on the back of these moves. The benchmark CSI 300 index is now up 13% this year. So is now the time to invest in China ahead of future stimulus plans? For more, we have Ben Harburg, CVA Greater China Growth ETF Portfolio Manager, as part of this week's ETF report brought to you by Invesco QQQ. Great to have you here with us. So let's start there. Is this the time to look at this region, look at China specifically, and say, okay, if there are more stimulus efforts coming forth, then I need to allocate at least a portion of my portfolio to that?
Well, there are two catalyzing events that we can look forward to in the very immediate future that would affect Chinese equity markets significantly. One is the upcoming 4 to 8 November NPC, so National Party Congress meeting, where they're going to roll out or at least define a lot of their economic strategy for the coming year. And of course, the US elections on November 5th. So it's going to be a gangbuster week ahead. Our view is that now is a good time to enter the market for two reasons. So one, the Chinese are continuing to stimulate the market. You're hearing incremental rollouts kind of week by week to coax the bears out of their dens and get them to buy on the high street and invest in the public markets. I think you will still see continued debt policies. But I think it's also the Trump election or the U.S. election that will catalyze a lot of it. Were Trump to be elected, I think you could see actually significant improvements in the Chinese economy, because there really is a deal to be had between the United States on all areas of trade and IP. And I believe that this time around, the Chinese would come to the table to do that deal. And that would actually normalize relations and make it much more a pragmatic relationship than we've experienced over the last 4 years.
And so with that in mind, Ben, as we're thinking about the ways to invest as well, should investors be looking at specific companies and stock picking, or is there kind of a concerted approach and looking at a basket of securities, ETFs, for instance, that would give them exposure to specific sectors that are set to benefit the most?
Obviously, the approach we've taken is to invest on the public side through our ETF, CGRO. The ETF aims to take a basket of about 30 to 40 names that are high growth. We actively trade them day by day, moving in and out of A shares, H shares, and ADRs in an effort to grab as much of the upside as possible as the market evolves very rapidly as a result of these stimulus measures. But again, in areas that we see where there's still a lot of room to run, so Chinese technology companies that are going global, domestic brands and domestic consumption drivers, domestic travel, fully integrated supply chains where China is starting to lead the world in the fifth industrial revolution, be it electric vehicles, handsets, solar. So all areas that we see huge opportunity for upside, but in a diversified and risk-adjusted way.
And so with this in mind, as you're looking at some of those areas where there's set to be a longer tail, how are you evaluating some of those opportunities and where investors could be looking for those returns? And is there a good rule of thumb for what type of returns you should be expecting when there's this amount of stimulus that's being put into the system in the region?
The first thing we're doing is we're looking for screaming buys. So companies that are irrationally and unfundamentally undervalued. So a company like Pinduoduo, for instance, which was trading at 9 to 12x PE, but growing at 80% a year relative to its peer comp Amazon growing at about 20%, but valued on a multiple of 45x. So these types of mismatches in valuation, companies trading with the amount of cash they have on their balance sheet, there's just so much irrationality in the way that the Chinese market was viewed, largely for geopolitical reasons, not for kind of fundamental economic reasons. And then we're looking at those sectors that, again, we see huge market share growth. So China, more than 50% of the electric vehicle market today, typically somewhere between 50 to 80% in solar panels, in mobile handsets. So all those areas where we see China can build out market share dominance and also then integrate other value drivers and other forms of revenue generation within those, say, applications built within a mobile handset and an operating system.
Does the election create an overhang for the China investment thesis right now, knowing how in the U.S. both parties have been talking about where they would need to be tougher on China or where they would just enact more tariffs on China?
To your point, I think a lot of that's baked in. So we can kind of consider today baseline when it comes to where the market is looking at and pricing China relative to the U.S. political intervention. So if we get a Harris administration, it's going to be more of the same, and so that probably is baked in today. But as I said, I think a Trump administration provides a binary, interesting outcome where a deal could be done with the Chinese. The Democrats have brought no deals forward to do with them. Trump administration could do that and bring it forward such that we could see improved economic relations between the countries, a reshoring of a lot of businesses to the U.S., protection of U.S. IP, but also enable that there is a more productive and progressive trade between the countries rather than this kind of ebbing tit for tat on tariffs and export restrictions.
Ben, just lastly, while we have you, and as we're thinking about the U.S. companies that have the largest exposure to the region as well, whether that be on a retail footprint side and being more business to consumer, or even on a business to business side as well, is there a way to look at some of the U.S. stocks that are also set to benefit most by the stimulus that China is looking to enact even further?
Well, certainly the objective of the stimulus is to kind of have a trickle-down effect to encourage consumption. So anyone in the consumption space, be it quick service restaurants, fast fashion, travel, will see an immediate benefit. But I think the U.S. Companies will see less of a benefit than they would have maybe pre-COVID, because there has been a bit of an export substitution, a gravitation towards local brands, local names, be it cosmetics, restaurants, soft drinks, and net result of that is that generally the Chinese brands, at least on the ground, are going to benefit to a greater degree than their global peers, who are often priced at a higher point and are being substituted.
Ben, thanks so much for taking the time here with us. Ben Harburg, who's the CVA Greater China Growth ETF Portfolio Manager. Appreciate it. Coming up, are you thinking of quitting your job? A career coach gives some advice on how to do it the right way. It's next.
When you realize that the job is not for you, this is a mental game. Okay, and I'm gonna share some tricks. In order to figure out what you want to do next in your career, you really have to go back to basics and understand who you are, what gives you joy, and what you're good at. I am a career coach of 7 years. I also have my MBA from Columbia Business School, and I also graduated from a 3-year program in shamanic healing.
Those were just a few clips from the TikTok page of our next guest. She's here to offer some advice for everyone out there who may be looking to leave their current job and find something new. Joining me now is career coach Mandy Tang. Mandy, great to have you here with us. First, let's start, if we will, with the latest labor market data. It shows the number of job openings at their lowest level since January 2021. And then the pay gains for job switchers is slowing, according to the latest data from ADP. At the same time, where we did see a massive jump for the month, at least compared to what the estimates were. So what advice do you give for someone looking for a new job in this environment?
Well, I think the biggest thing that you have to do in this kind of environment is you have to have a lot of resilience, because the market is tough. And it used to be that it would take maybe 2 months, 3 months, and you could land a new job. And now what we're seeing is that it's just taking longer. It's taking 5 to 6 months, sometimes more. And a lot of people, this is really outside of your comfort zone. You're putting yourself out there. You are having to network, which is terrifying. You're having to apply all the while. You're probably applying to a job because you're unhappy with your current one. So it really is about managing your energy levels, managing your own expectations, and going into it with a state of mind of resilience.
What is the best month to look for a job?
So technically, the best month is probably going to be January, February. So the beginning of the year when people are kind of back from the holidays. That being said, yes, there are like certain seasons that are generally good, January, February, like I said, and then May, June, so right before summer vacations, and of course, September, October, which we're in the tail end of. A lot of people are going to say, holidays are coming up. Should I just wait? Like, there's no point in applying. My advice is that there's no perfect time to apply for a job. And if you are unhappy, then you should start looking, because the process does take quite a few months.
Are there tells about the time of the year in which you see a listing go up from a company about how much they might need that position to be filled, where you can negotiate better, and where you can ultimately make sure that you yourself are showing up fully for the ability to take on that new position as well?
Yeah, so some of the tells would be if you are watching a position get reposted multiple times, that means obviously they're having trouble filling it. You also want to look at the job postings kind of like as a constellation, right? So seeing what kinds of positions they're hiring for, in which departments that they're investing, that really shows you where the company's going and what they value. In terms of how you can show up, I think that a lot of people feel like this is a very high stakes game. Like, there's one company that I want and it's my dream company. And if I don't get that job, then I'm a failure and I should just stop. I think we need to look at it way more incrementally as a series of small bets where you can say, okay, I'm kind of interested in this company here. I'm kind of interested in that company there. And I'm going to apply here, I'm going to apply there. I'm not going to put all my eggs in one basket, and I'm not going to get emotionally wedded to the idea of one job. I think that you have to kind of spread your chances and take a bunch of small bets.
Within the Conference Board data, we saw views on the current availability of jobs rebound, and that was after several months of weakness here. If someone is thinking of quitting and maybe they're burned out or realize the job they have isn't the right fit, what tips would you give them?
So I think that burnout, so you mentioned burnout. How I define burnout is when your external circumstances do not match your internal landscape. So let's say you value a certain thing or you've outgrown a certain thing. So burnout is that action where the gears are kind of contradicting each other. Okay, and what that leads to is a lot of emotional exhaustion and a lot of tiredness. We feel like it takes a lot to even show up because we have to mask at work. We have to pretend that we're happy when we're not, right? And so what I really think the answer is to look inside and be like, what matters to me now? Kind of get current with your aspirations and your dreams, because they could have changed. They could have changed in the past 6 months. Get current with that and then think about, okay, so how do I feel inside?
Right.
And then what can I do to make my external circumstances match that, to match that energy?
Career coach Mandy Tang. Mandy, thanks so much for taking the time here with us. Very valuable tips and insights. Really appreciate it.
Thank you.
Coming up, everyone, getting retirement ready. Yahoo Finance's Decoding Retirement host Bob Powell speaks with Ann Lester about how millennials and Gen Z can catch up on savings. Stay tuned.
How much should you have saved for retirement? Well, that's the question we're going to answer on today's episode of Decoding Retirement. Hi, I'm Bob Powell, and today we'll be talking with Ann Lester, who is author of Your Best Financial Life. Ann, welcome.
Thanks for having me.
Oh, it's a pleasure. So one of the things that we aim to do on Decoding Retirement is to go behind the headlines. And I want to share with you some headlines that came out recently. It was a study by Fidelity Investments, and Fidelity, in essence, reported that Gen Z plan participants, 401k plan participants, had saved $11,300 in their 401k plan. Millennials had saved $59,800. And one of the interesting things about this survey to me is Fidelity and others, JP Morgan, T. Rowe Price, others have said there are certain savings targets that people should aim for. 1 times your salary by age 30, 3 times by age 40, 8 times by age 60, and 10 times by age 67. And when I look at the average salaries for Gen Z and millennials, what strikes me is that those asset amounts are way below targets. And I'm curious, one, your reaction to the survey, and also what's the actionable advice for people who may be behind the 8 ball?
Yeah, so I always want to approach these numbers with a tiny grain of salt. So one is averages hide a lot, right? So some people are saving nothing. Some people just started saving last week. Some people have been saving 10 or 15% of their salary since the day they started working, and they get the gold star. But let's just say that $11,000 number, if you are 30 years old, that means you should have saved $110,000. No, I'm doing that math wrong. If you're earning $56,000 a year and you're 30 years old, you should have saved up $56,000, right? So that is a big gap from 11,000 to 56,000. So number one, the oldest Gen Zers are 27, so they got a little more time. Number two, there is a lot of job hopping happening with younger workers. And so, to what extent have those people worked for the same company for the entire time or rolled their money over into the new plan? So it's possible that those numbers may be slightly understating the amount people have actually saved. But I think the headline is probably right, like people should be saving more money.
Right. So I think about that. I have a daughter. She's changed jobs twice now and left her 401k at her former employer and did not roll it over to her new employer or into a IRA. So in that case, we're looking at perhaps this possibility that she does have 1 times her salary saved or so.
Just not all in one place.
Right. So I'm thinking if someone is in that case, it's far better for them to roll over their old 401k to their new employer.
If they can, that's always, I think, the right strategy.
Right. And if not, keep it at the old employer or move it to an IRA?
It depends, right? And I know we'll talk about this a little bit. I wrote a book recently, and I dive into a lot of these questions. And one of the things you need to think about is, the mental tax on, like, dealing with it, which is non-trivial. Like, it's actually not super easy. I know there is a whole bunch of initiatives to make this easier, but we're not quite there yet. Number two, if your old plan is the fees are high, you may want to roll it out into an IRA. If the fees are very low, if you work for a very large company, it's very likely that you are paying very, very low fees, and it's probably better to leave it alone. But you've got to do a little research to make that decision. The bottom line, though, is if you're leaving it in your own plan, it's safe. You just don't want to forget about it.
Right. So the important thing is if you have multiple accounts or one account, to use these benchmarks 1 times your income at age 30?
Absolutely. I think that's a really good rule of thumb. It's, when you get closer to retirement, if you're in your 50s or 60s, you might want to start digging in a lot more to these general rules of thumb. But certainly in your 20s, 30s, and 40s, I think those are very practical sort of ways to gauge whether or not you're kind of roughly on track.
Yeah. And what about if someone's behind the 8 ball? So they have 11,000 saved, they need to have 56, increase their contribution rate, spend less.
All of the above. So most people are not saving quite enough, right? And Gen Zers are actually, out of all the generations, when you look at the data, doing a better job of being closer to what we think people should have, because more Gen Zers are getting automatically enrolled in plans, and this is a fairly recent trend, but more employers are starting to automatically escalate their contributions or increase them. If you've been automatically enrolled into a plan at 3% of your salary, that's a great place to start, but it's a terrible place to stop. You really need to be targeting 10 to 15% of your salary over time. The trick is you don't need to try to get there all at once. So if, let's say, you're 25, you're earning $50,000 a year, and I'm telling you, yeah, you should try to save $5,000 to $7,000 of your salary. You're going to tell me to jump in the lake, right? So how do you get there from here? Well, you don't try to get there all in one go. What you do is borrow a trick from the Nobel Prize winners who came up with Save More Tomorrow, and that means you make a very strict commitment to yourself today that the next time you get a raise, which will hopefully be in 3 or 4 months at year end, you will take half of that raise and direct it towards your long-term savings.
All right. So the common advice, though, is for people to take advantage of the full employer match. And oftentimes that means contributing 6% in order to get 3% extra, which puts you at 9%.
I think that is 100% directionally where you need to be. The question is, if you are starting out and you're in your early 20s and you're living in a city that is expensive, that's just really hard to get there. And I guess the thing I want people to take away is you need to have that as your goal to get there. You don't have to start there if you're still trying to figure out how to balance your checkbook. Like don't set this incredibly high bar, fail, and then say this is never going to work, I give up, right? Make it a plan. How am I going to get from where I am today to where I need to be in a year?
All right,
and then you step into that gradually.
So we can throw out the ramen noodle diet for now?
Well, if that's what you need to do to stay out of debt, you need to be eating ramen noodles. But the next time you get a raise, you can take a little bit of that money and upgrade from the ramen noodles and also save more.
Yeah. So when I think about debt, I think a lot of these younger workers are only, they're two things. One is they're trying to save for retirement, which seems implausible when you're in your 20s, but also pay down student loan debt. Right. And that's a hard thing to do. You've got these two huge expenses.
Well, and rent. Let's not forget rent. I mean, it's a lot, right? So you're looking at, I think a lot of people starting out are you get your net paycheck, right? You've paid your payroll taxes, you've paid your income tax, you've paid for your health insurance, and what's left is already 60 to 70% of what you thought you were going to get, right? So that's already a little math. Then you pay for your rent, and then you pay for your student loans. Then with what you've got left, you need to create an emergency savings fund and save for retirement. So again, starting out, first job out of college, I think it's very unrealistic to expect people to be able to save 10 to 15%. So all I'm saying is start slow, start immediately. In the course of 3 or 4 years, you should be planning on building up that percentage that you're saving until you get to that 10 to 15%. And I think that is very doable for many people,
right.
Most people even.
So if someone does have student debt, I'm thinking, and especially because of Secure 2.0, some employers, not all, will match the amount that you're paying towards student loan debt.
Right. And that is, starting early for saving for retirement is the biggest gift you can give yourself, right? The power of compound returns is one of the biggest things most people don't get. So the dollar you save in your 20s is going to be worth, triple or quadruple that amount in your 50s and 60s. So it's really important to start early. If your employer matches, you should absolutely be taking advantage of that because that is free money.
Right. And if that's the case, would you suggest that they put all of their extra money toward paying down student debt or split it?
I think it's very important to have an emergency savings fund. I think that is absolutely critical. So I think if you have the opportunity to pay down your student loan debt and you have zero in emergency savings, you should be trying to do both of those. Once you have an emergency savings fund built up, then I think it's really important to take that money that you were saving for emergencies and throw it into your long-term savings, whether that's paying down debt and getting all of the match, or whether that's just starting to contribute money into the 401k plan as well. I think the question, right, about how much fun money do you give yourself is a really personal one. I am a walking example of someone who has been much more of a grasshopper than an ant. And I have never met something fun that I don't want to spend my money on. That's pretty true. So I struggle a little with that rule that says you should be, maximizing your saving from the get-go. I think if you feel poor and like you're missing out on things, it's a tough thing to feel. At the same time, you need to figure out how to pull your lifestyle down to a place where you're not increasing your debt burden, right? You don't want to be putting anything on credit cards. You don't want to be running up that debt. But I think, again, and I'm speaking especially when you're just starting out and you're at those very low salaries, you can expect fairly significant pay increases for the first sort of decade or two of your working career, and it is okay to let your lifestyle increase a little bit along with those increases in pay. The trick, though, is to not let your lifestyle completely eat up all of those raises. That's when you really want to boost your savings. So, like I said, I think you can start saving less in your early 20s and be targeting that 10 to 15% by the time you hit 30.
All right. So for young workers, this is extremely complicated. Let me throw out a rule of thumb for budgeting, where some people suggest 50, 30, 20 as the rule of thumb, 50% for sort of essential expenses, 20% for savings and debt, and the rest for fun.
I think that's a great rule. I guess I just, having talked to my own kids and a lot of young people who are starting out, that 30% is like not there because their rent's so high, right? I mean, so it's like really what's the bucket of money you have left after you pay off your housing, after you pay for a minimum amount of food, and after you pay for all your debt servicing, whether it's student loans or other debt you might have run up. And then that, to me, you should be saving half of it and spending the other half on fun.
Right. So we've talked about saving for retirement, paying down debt. There are other expenses that they need to think about. Disability insurance, maybe life insurance so that they can guarantee insurability, health insurance, et cetera, et cetera, et cetera.
I think one of the biggest risks people run is the risk of catastrophe, right? And that is really what insurance is for. So health insurance is a very common catastrophe that is, when you're in your 20s, you tend to think you're invincible. You have no health problems, everything's great. And then you have an accident, something, all kinds of things can really derail you. So being underinsured, whether it's for health insurance, renter's insurance, if you're renting, right? You are one roommate forgetting to lock the door away from getting wiped out. car insurance, right? Not insuring your vehicle for its replacement value, but just getting the bare bones minimum, which I think a lot of people do. I did that once and never again after somebody else hit my car, and I, like that was it. I had to dig deep in my pockets. The car it's not worth insuring this car. It's only worth a couple $1,000. Well, let me tell you, I was very sorry I made that decision, right? So being underinsured is a huge risk for people, and most people don't understand they're running it. Insurance is cheap. Health insurance, different story. Every other kind of insurance is really pretty cheap.
And we have to take a short break right now, but when we come back, we're going to talk more about your book, Your Best Financial Life. Welcome back to Decoding Retirement. We're talking with Ann Lester, who is the author of Your Best Financial Life. Ann, I want to talk more about the book, and in the book you have some actionable advice I want to get to. One is this notion of STASH, the acronym, and how young adults can hack their brains to stash more money.
That's it. And we have actually been talking about it a little bit, right? STASH stands for sort of the 5 things you should be thinking about. Number 1 is save for a rainy day, right? That emergency savings fund. Number 2, tax advantage savings. So using the power of compound returns and the growth of that money to really grow your money. So T, tax aware savings. The A is assess your budget and pay off debt. So once you start your emergency savings fund, once you're getting at a minimum the match, which is your first target, right, to get that match and get the free money, then you start paying down debt. Now that is there's some disagreement in the people sort of talk about this stuff about whether you should be tackling debt first or long-term savings first. For me, the power of compound return over time plus the 401k match, if you get it, is more important than aggressively paying down debt. Once you get that match, you get the free money, which is doubling your return because they're doubling what you put in right out of the gate. Then you aggressively pay off debt. After you are debt-free for everything but low interest rate debt, and again, people can argue about what that means. In my book, I refer to anything under 7% as being low interest rate, which is less than what you might earn in the stock market or in a balanced portfolio. So typically a mortgage, some federally guaranteed student loan, right, is below that 7% rate. Everything else you should be paying off as fast as you can. Then you go to the 4th step of STASH, which is the S, which is max out stay the course and max out on your retirement savings and get up to that 10 to 15%. And then the H stands for have fun. right? Once you get to that, let's call it 15% savings rate, you really should then be allowing yourself to enjoy more. Maybe you're going to save more money and save it up for a bigger down payment or for a fancy vacation, or maybe then you want to think about not retiring at 67 but at 60, or that's when you have a little more room to think about different kinds of goals. But I think executing that stash is really about making sure you've got the emergency savings fund, you have eliminated all of your high interest rate debt, and you are putting, again, 10 to 15% into that long-term savings.
Right. So as you're talking, and you mentioned the ant and the grasshopper story a little bit ago, I think about how many young people have two things going on: present bias, the possibility that they value today's dollar more than tomorrow's dollar, and this notion of fear of missing out and having fun. So I'd rather go out to this and do that, or this concert, or go to London and see Taylor Swift, or whatever the case may be, because tomorrow I'll have another dollar and I can worry about that then.
So true. So true. I mean, I'm out there giving speeches and stuff, and in one of my speeches, I won't do the whole thing now, but I'm like, so I'm watching Netflix, and it's 10 o'clock, and the next episode starts, and I hit skip intro and think, wait a minute, what time do I have to wake up? And then it's 10:30, and then I hit skip intro again, and then the next thing you know, it's 1 o'clock in the morning, and you think, I've only got one episode left. I'm going to keep watching, right? We've all done that. That is present bias in action right there. Right? What is happening right now is far more important than the future, which is tomorrow morning, right? So it's a thing. I think the most important thing we can do is get curious about how we are wired. Like, it took me a really long time to accept that I am a grasshopper. I routinely start reading a book at 9:30, and at 2 o'clock, I'm like, oh boy, am I going to be sorry tomorrow. I still do it, right? And I have learned not to let myself start reading without either setting my phone alarm on and putting it across the room so I have to stand up to turn it off. Okay, that's my signal. Stop reading and go to bed. Like, I'm bad at that. I'm bad at that kind of impulse control, right? I just am. So I know that about myself with something as silly as staying up late reading a book, and I can then create hacks, turn on my phone alarm, set it out of reach so that I have to stand up, which disrupts me enough to go, wait, whoa, what time is it? I better put my phone, I got to go to bed. You can do that with food. You can do that with money, right? How do I understand what my own biases are, my own impulses, enough to figure out how to interrupt them, right? So one of the most powerful things that is now helping Gen Zers and anybody who changes jobs is getting automatically enrolled, right? When you and I started working, we got these, 150 or 200 page enrollment kits that we had to fill out and mail in with hundreds of pages of information to look at. Like, that was horrible. What the stats were, 50 to 60% of people signed up. If your employer signs you up, only 3 to 7% of the people drop out, right? It's magic. That's a huge hack. So is your employer automatically increasing your savings rates? That's another hack. Most people stay with the plan. They don't drop out because they know they should. If your employer doesn't do that for you automatically, you can do it to yourself by, again, either asking them to increase your contribution rate or just saying, hey, Jan 1, got a raise. I'm gonna bump up my rate, right? Those are hacks that will help you stay on track.
So as I look at your book and the topics in there, and I think about your children, which you, I believe, dedicate the book to.
Yes.
So have they incorporated your advice?
It's funny, my older son, like me, has an eye for, like, you could put me in a store with no price tags and I would unerringly find the most expensive thing. It's a gift. Not a good one, but it's a gift. And my older son is like that, but he is being really ruthless about creating guardrails for himself. And he is 100%, my children were also fortunate enough to graduate from college debt-free. That was something my husband and I felt very strongly about. They're on their own for grad school, but they have managed to, get out of college debt-free. And so that is a huge boost that and I said that to my son when he started. I'm like, well, look, you're not paying off student loans. You should be throwing money in your savings plan. So they're following that. My younger son is much less like me and much more like my husband. He's like, I don't have the money. I don't care. But he's also a musician and is going to be leading a really different life, right? It's all on him to be saving and investing. And, we've had a lot of talks about how do you think about managing a gig world when you don't have a 401k, you don't have somebody automatically enrolling you. How do you think about structuring your spending if you have great uncertainty about what your income's going to be like?
Yeah. So, quick question. Given the amount of jargon and how obscure this can be to some people whose day job is this, and this requires a whole nother day job, should young workers go to a financial advisor for help?
I think financial advisors can be incredibly helpful. I think most people starting out have pretty straightforward financial lives. And not to talk what I used to do for a living, I used to manage target date funds for a living, right? So I think a target date fund is a great answer for someone just starting out, or a balanced account, or a robo platform. I don't know that you need a financial advisor unless you are struggling with how to budget and save. And then I think having someone who can help you understand your own finances, understand where your money is going. Someone who takes a percentage of your assets when you're just starting out, I think those fees are probably going to be very high. And there might be other places to find that kind of help.
So, Ann, it's now time that we turn our attention to questions that we get from our readers and listeners about money and retirement in the segment that we call Ask Bob. The first question that came in essence, goes like this. Is there an upfront charge when I convert my traditional IRA to a Roth IRA? And in essence, the answer is no, there's no one charging you a fee to do that. But, however, you will be paying ordinary income tax on the distribution from your traditional IRA, and you need to be aware of what that tax will be and how it might affect other things. If you're if you're a Medicare beneficiary, you might be subject to IRMA if that puts you into a higher income bracket. Modified adjusted gross income is the jargony term. And if you're pre-Medicare and on the ACA plan, it could affect the advanced premium tax credit that you get.
And it can also bump you up into a higher tax bracket. So it's interesting. I was just talking to my parents' financial advisor about that. My parents are both in their 90s and doing some chatting about just this subject. And it was going to bump them up like 4 tax brackets if they did a conversion. It's like, well, never mind. We're just going to leave that money right where it is. Thank you very much. Because it would radically alter all kinds of things. Now, most people, again, if you're younger, may not matter that much. We can chat a little bit about, if you're just starting out and have the choice about contributing to a Roth or regular, like we can talk about how you might think about that decision. But that conversion, right, the government's going to make you pay, not necessarily your service provider. That should be free.
Yeah. So one last final word is you don't have to do a full conversion. You can do a partial conversion.
Right.
So another question that came in is, can I withdraw money from my Roth IRA after I've contributed? And the answer is yes, if you've held that for 5 years. Otherwise, you'll pay a penalty on that distribution. And there are a couple other nuances to that. But in essence, if you've had the Roth IRA open for 5 years, you can withdraw money from it. Any thoughts?
Well, 59 and a half is one of those ages that you need to pay attention to. Where the half comes from, I do not know. But that is the age from which you are sort of normally allowed to start withdrawing. Before that, you'd pay a early withdrawal penalty. Roth IRAs have other things you're allowed to pull money out for, down payment on house, education expenses and stuff. So, a Roth gives you a little more flexibility, but you still have to keep an eye on the fine print.
So thank you, Ann, for sharing your thoughts on these questions from our readers and listeners. If you've got questions about money or retirement, email us at askbob@yahoofinance.com. That's all the time we have today on this episode of Decoding Retirement. Stay tuned for future episodes where we'll be talking to other experts who can help you plan for and live in retirement.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
That's it for Wealth. I'm Brad Smith. You can stay tuned for Market Domination that comes up 3 p.m. Eastern Time.